you want to get your finances in order, but you feel overwhelmed, you don't know where to start, then this course is for you. I truly want people to win with their finances, pay off debt, save money, increase your income, invest money, feel financially secure, reach financial independence, all the things. And that is the goal of this video. I want to help you feel more financially stable. And obviously, I can't fit every single thing about personal finance in this video, but this is going to be focused more on the how of personal finance, not so much the teaching. I'm definitely going to incorporate educational pieces in this, but I'm not going to be talking about or explaining tax brackets or the difference between APY and APR. I want to give you actionable steps to help you gain the confidence to do what it is that you need to do to improve your financial situation, whether you've just filed bankruptcy or you're planning out how to retire early. Before we get started, I would grab a notebook and a pen or your iPad, your laptop, whatever it is for you to take notes and do everything that we're going to go through. Or you can download the workbook that I've created to go along with this course. You can find that link down below in my description box. My Google Sheets templates will be included with that as well, and I will explain everything in this video as we go through things. You will also need access to your numbers, so you're going to want your laptop and phone for that anyway. Also, if anything in this course doesn't apply to you, I have timestamps, so you can click around where you need to. And of course, if you want to work through everything as the video goes, you can just pause me and then resume as needed. I am a financial coach and I've worked with dozens of clients at this point, and I kind of loosely follow this 4-phase system, and that's loosely what this video is going to be based upon. So first phase would be awareness. Second phase is budget and optimize. Third is systems and habits. And then the fourth is build. So of course, we're starting with phase 1, which is awareness, or what I like to call a financial snapshot. If you've been avoiding your finances, please comment that down below. I find that with my clients, this is the largest hurdle for so many of them. They feel a lot of fear around looking at their numbers. They just want to avoid it, and they have avoided it for years, and that's kind of a big part of the problem. So this step may feel tough for many of you. You may feel shame around it, guilt around it, just a lot of negative emotions, but just push through, because this is where change begins. You can't change anything if you don't know what things look like currently. First numbers that we're starting with would be your debts, if you have debt. And if you've been avoiding these numbers for a while, then this is also a good time to save those login credentials or put it in your favorites bar so you can access these easier later. So I want you to list all of your debts. You don't need to put these in any order right now. We'll talk about that later. But what I want you to include is who you owe. So who the debt is with, like American Express or Chase or your mortgage lender, whoever it may be. The current balance, not the statement balance, the current balance as of you watching this video. The interest rate, the current minimum payment, and the due date. So the day of the month that it is due on. So if it's due on the 8th of the month or the 20th of the month, you get the idea. You can just jot these down on paper if you prefer, or you can use my Google Sheet template. I will do an example of one. So let's say you have an American Express credit card, and let's say the amount that you owe is $10,400. The minimum payment is $300. The interest rate is 22.99%, and the due date is the 7th of each month. That is all you do. You can do this for all the debts in your life. Your student loans, I suggest breaking those out individually. So if you have 4 different loans under the same lender, they probably have different interest rates. So I would break them out based on that. And I want you to include all of your debts. Don't forget about anything. So if you're financing your phone, list that on there. If you have any buy now, pay later, like Afterpay or Klarna, add that in there. Do you have a mattress or a laptop that you're financing? Add that. So everything that you can think of that you owe money on, I want it included in here. By the way, if you're having a hard time finding the interest rate on your credit cards, I'm going to show you how to do that. So I am logged into my Capital One account. I need to pay this card off. So this is obviously with just one bank, but whether it be Chase or any other bank, it's going to be pretty similar to these steps. So you want to look for something that says statements, or even sometimes under I want to, it'll be like I want to see statements, or You get the idea. But for Capital One, you can go to view statements and you want to go to your latest statement. And then on here is where you'll be able to find the interest rates. Usually you don't even need to download it. You just click and it's going to come up. So on here, you see quite a few numbers. Now I do pay off my credit cards every month, so I'm not going to have any interest charged. You would be able to see that here though. So if you were curious about how much interest you paid in the last statement cycle, you should be able to see that at the top, but you're probably not going to see your interest rate here. You're going to have to scroll down until you find a table. Keep on scrolling. You'll see your purchases. Keep going. Keep going. Okay. Until you see interest charge calculation. And this is going to tell you your current APR. So for my card, any new purchases would be 24.49%. And it's going to tell you the balance subject to this interest rate, because some of your cards you may have a balance transfer on. So it should also break that down. Any purchases that you added on in the month and you kept them there, you didn't pay them down, it will tell you how much of that balance is getting this interest rate and how much that actually is the amount charged. And then if you have a balance transfer, it will also be on here in this table and tell you if it's 0% or it could be like 9.99%, something lower. And then that one will also give you a balance that is subject to that interest rate and how much interest was charged for that balance transfer. So you should be able to see the difference in this table. And honestly, while you're here, I want you to look for another table that, I don't know if all banks do this, but I've seen it very often, where it breaks down how much this debt would cost you if you just paid the minimum payment. It also should tell you how long it would take to pay it off. And I will put up an example. So this was somebody that I worked with. Their balance was about $14,000. If they only paid the minimum payment, it would take 29 years to pay off that debt. That's a mortgage. That is a lifetime of a mortgage. And instead of $14,000, they would pay $41,709. That's crazy. It's usually some wild numbers that you will see there. And if you're open to sharing, please put that down below in the comment. This is not to make you feel bad or stressed out. This is just so that you realize how much money you can lose by keeping this high interest credit card debt or any debt. And you are going to change that. You are changing that and taking action on it by watching this course and working through everything. So that's not going to be you. You're going to pay it off much faster and you're going to save on interest. Hopefully you know all of your debts and you have them all accounted for, but I've worked with multiple people who after a couple of weeks, they were like, oh, I forgot I had this debt, or I had them run their credit report and they discovered they had an additional debt or maybe even a debt in collection. So if you haven't checked your credit report in some time, not your credit score, your full credit report, then I suggest pulling that. It is free for you to do one time in the year. Go to annualcreditreport.com and enter in your information and you can see everything. I know that the credit report, when you download it, it's kind of overwhelming and you may not be sure what to be looking for, but just take your time with it, review all the numbers, make sure everything on there is actually yours. If you notice anything that like you didn't take out that debt or there's some error, then be sure to file a dispute. If you're missing a debt from your list, be sure to add it. If you have debt in collections, also add that and make sure you take note of who the debt is currently with so we can figure that out later and make note that it is currently in collections. The next numbers we are going to look at are your assets. These are things that are valuable in your life. So this would be your checking account, your saving account or accounts. If you are earning interest on your savings account, be sure to jot down the interest rate that you're currently earning. We'll come back to that. You can include any cash that you have on hand as well, your retirement or investment accounts, and then you can include the value of some belongings that you have, like jewelry, your car, if you have your home, the value of your home, anything like that. Personally, I do not keep track of the value of my car. It's not a number that I include in my net worth. Same thing goes with like any jewelry that I own or any like more expensive belongings that I have. But if you want to, you absolutely can count that. Add it to your list. That's fine. Again, my spreadsheet has room for this. So if you have your checking account and you can specify, maybe you have it with Chase. And then you can say you have $3,456 in there. And then you have your high yield savings account, and maybe that's with Marcus. And in there you have $1,045. Maybe you have a 401k through your employer, so you can enter that in. Maybe you have a Roth IRA, a brokerage. maybe you have some cash, maybe you have an old 403b or something else, just any of your assets, list them here, and then they will all total up at the bottom. Again, if these are accounts that you're not used to logging into and reviewing on a regular basis, then make sure you save those login credentials and or add them to your favorites bar so you can access them easier later. So now you're aware of the big numbers in your life, your debts and your assets, and you can calculate your net worth with this information. So you can add up all of your debts. My spreadsheets will do that for you automatically. Same with all of your assets, add all of those up. And then you will subtract your debts from your assets, and that gives you your net worth. If you calculate your net worth and it's negative or your number that you're not happy with, please do not stress about it. This is just a number. It doesn't mean anything about you. This is just data that I want you to have, and this is your starting point. And if you actually take action on all these things that we're about to go through and you stay consistent, you don't need to be perfect by any means, but if you implement these things that I'm about to talk about and just keep at it year over year over year, imagine where your net worth can be 1 year from now, 5 years from now, 10 years from now. Your net worth is going to grow, okay? So having this to look back on is going to be really cool. One day you're going to be like, oh wow, look at how far I've come, and I wish I started tracking my net worth sooner than I did. So this is your starting point. Now we're going to be looking at your spending. I suggest having at least 3 months of data, but you do have a few options here. So option number 1, you may already be tracking your expenses, which is great. So if you're already tracking, then you can move on to the next section. Option number 2 is logging into the bank apps that you're using most often for purchases and using their built-in tracker to look at the data from the last 3 months, or even more than that if you wanted to. However, I would look at things a bit more closely than their defined categories, because they could be categorizing, maybe you went to Target and they are categorizing that as a grocery purchase when really it was like clothes and books, and that would be personal. So you can use that, but I would pay a little bit more attention to it and break it down on your own, like on a piece of paper or within your spreadsheets. Option number 3 is downloading an app, like a budgeting app, and linking your bank accounts that you are using most often. And hopefully it pulls in past data as well, like past spending history. Lunch Money is a great app for this. And I do have a referral link with Lunch Money. And through my link, you can get a free 60-day trial. That's plenty of time for you to get this done and collect some data. It will take a little bit of effort initially. So you're probably going to have to categorize some of your transactions. But from the beginning, it should be pretty organized and you should be able to get a pretty good idea of where you spent your money for the last 3 months. Option number 4 is manually going through all of your transactions from the last 3 months and categorizing as you see fit. So this could look like downloading your statements. You could run it through ChatGPT if you wanted to, but be careful with that. I would block out like your address, any account numbers, things of that sort. But you can do this manually. You can use paper and pen just to list things out. I actually have a very simple spreadsheet for this where you can list all of your expenses by category. It's going to add things up and also take an average. This obviously is going to be fairly time consuming, but I do believe it is worth it. Or there's option number 5 where you can skip tracking any of your spending from the last few months and just commit to moving forward. You will be tracking your spending. You are going to be paying attention to your spending, ideally tracking every single penny or close to it. You can round up if you want to, but even better if you can get more detailed. And honestly, this goes for just about anyone, whether you're choosing a different option or this option number 5, where you just skip this step. Moving forward, I want you to track your spending, because if you don't know where your money is going, then again, you can't change anything. If you do choose to skip your past spending, just know that making your budget, that's going to be one of our next steps. It's going to be a little bit more difficult because you're not going to have any data to go off of. So you're going to be guessing some of your numbers, and that's fine. But that's where, you got to start tracking after that so that you can clean up your budget as the months go. At the very least, you can jot down your known expenses, your fixed expenses, like your rent, subscriptions, maybe even your utilities, minimum debt payments, which you've already got, your gym membership. You get the idea. Next, we're going to be looking at and kind of planning out the whole year. It doesn't matter when you're watching this, whether it's the middle of the year, end of year, beginning. you can still use this. So on my template, I have a tab that's called Year at a Glance, and you're going to see all of the months laid out, kind of like a whole year calendar view. You can do this on paper if you wanted to. And all that you're doing is listing any expenses that you know are coming up in the year or occur in those months, the kind of unusual expenses. So a common example for a lot of my clients would be like Christmas in December, and you want to spend $1,000. So you would just write Christmas, $1,000. My sister's birthday is in October. So sis B-Day, how much you expect to spend on that? I'm going to put $100. My birthday is in July. So I know that I need to get my car emissions and car registration. That costs me like $50. So I like to put that in there. My car insurance renews in May. And lately that's been like $850. It also renews in November. So I'm going to put that in November as well. This September, I'm traveling, and I know that I still need about $2,000 for that. So I'm going to put $2,000 there. But whatever information you have about the things coming up throughout your year, that's what would go on here. It doesn't need to be everything. You don't need every single expense. That's what your monthly budget is for. This is for those random one-offs or the things that you need to prepare for. So it's usually travel, subscriptions or memberships that come up annually. I pay my phone bill every December, so that's on my Year at a Glance. Gifts that you want to prepare for, holidays, birthdays, car insurance premiums, property taxes, anything you can think of that you're often forgetting, put it here, and then you can always come back to this and add to it. This is awesome to reference when you're making your budget on a monthly basis, but also can help you to determine which sinking funds to create, if any. So we will come back to that, but there is an area here for sinking funds. That's just specific savings accounts. And usually by creating this, you can be like, oh, I need to start a travel fund because I have some travel coming up. And if I save $500 every month until then, I will be good. So yeah, we'll talk about that in just a bit. All right, I know this first step has already been a lot, but we have one final little snapshot to look at, and that would be your employer benefits and your paychecks. Unfortunately, I know not every employer is awesome and has like these awesome benefits package. But if you're unsure of what your employer may offer, I highly encourage you to look into it and take advantage of every single thing that you can while you are employed there. So if it's been a while or you've never looked at the benefits that your employer offers, you want to look for like an employee handbook or guidebook, or this may be in your welcome packet when you first join the company. So what you're going to want to look for, of course, there could be a number of insurance options available to you. You're probably taking advantage of health insurance already, vision insurance, etc. Maybe over the last couple of years you had a child and you haven't been taking advantage of their life insurance or something like that, so you could add that in. Also, if your health insurance is a high deductible health plan, do you have access to an HSA? And if so, are you contributing to that? If you can, we'll talk about this more later, but maybe your company is matching your contributions to your HSA or contributing in general. So if you're not sure, then find out. Of course, a retirement plan. So 401k, 403b, 457b, TSP, depends on which sector you work in. Does your company offer that? Do they offer a match? And if they do offer a match, is there a vesting schedule? This is very, very important and can help you to determine if you should be contributing to your employer-sponsored plan. So when it comes to any retirement contributions that you do, any money that you are putting in, that money is yours. So if you were to leave the company after 3 months or after 2 years, that money is automatically yours. But when it comes to a vesting schedule, if a company offers a match, if they have a schedule, then it depends on that if that money is yours after you leave. So let's say they have a vesting schedule of 3 years, which I hate to see it, but unfortunately companies do this. If 3 years is their vesting schedule and they offer a 6% match, then you would not get to keep that money if you left the company before that 3-year period. So if you worked at the company for 4 years and then you left, anything that they contributed into your retirement plan would be yours. But before the 3-year mark, it may be that you don't get to keep any of it or a portion of it. Could be like a prorated amount. Hopefully, if your employer does offer a match, then you are vested immediately. That is the ideal situation to be in, but definitely something you want to be aware of. So when you're looking at your handbook or the welcome packet, do a search of vesting or vested, VEST is what you want to look for. Make sure you're aware of PTO, sick days, paid holidays, volunteer hours. Do they offer any employee assistance program? Do they have a referral program where you can refer somebody to work at the company? If they get hired, you get paid something. Do you get a gym membership stipend? Do you get a phone stipend? Do they offer pet insurance or discounted pet insurance? Any paid training, tuition or student loan coverage, a wellness program, free therapy? You get the idea. Basically, just ensure that you're not missing out on anything, okay? Now I want to walk you through how to read your paychecks, and these are something that I do suggest reviewing every so often, especially if you notice a number hitting your bank account that looks odd, whether it's short, whether it's higher. Take a look at your paycheck and make sure everything looks all right. Y'all, literally, my own husband didn't notice that for all of 2025 and the first 3 months of 2026, that 0 federal and 0 state taxes were being deducted from his paychecks. So guess who got a hefty tax bill when they filed for 2025? So what you're looking at is actually one of my paychecks from my last job, and yours should look fairly similar to this. There's going to be very similar deductions, and yeah, the breakdown should be pretty similar. Your information will be at the top, so that's what is at the top of this. But down here, we have my earnings. So I was salary, it was not hourly, but it just breaks it down by hours. And then my current gross pay, so that paycheck alone, $2,940. And then YTD stands for year to date. And that is how much I had made year to date with this paycheck. If you get a bonus from work, that may also be listed there, or any other pay that you're getting should be listed under earnings. For this paycheck specifically, I did not receive a bonus, but year to date, I had already received a bonus of $3,402. So that's what that is. And then this fringe benefit at my company, we could sometimes cash out gift cards based on like this little reward system that we had. And they started taxing that. So that's what this was. I had redeemed a $25 gift card. So it got added in as income. And so I had to pay taxes on that, which was kind of annoying, but whatever. And there should be a section for taxes. So taxes withheld or taxes deducted. If you're not seeing any taxes taken out, know that something is wrong. So going back to the example with my husband, had he just looked at his paychecks, he would have seen, oh, no taxes being taken out, and I need to fix something with HR. So you're going to have federal income tax, current, that's what I paid on this current paycheck. Again, YTD, so far in the year, I had paid that much. This was a paycheck that I had received in April, by the way. Medicare tax, that was on there, how much was deducted. Social Security tax, and then state withholding. I live in the state of Georgia, so we do pay state tax, and that's included in there as well. Again, all of these have year-to-date totals as well. You should also see other deductions. So medical deductions, I was paying a portion of my health insurance. This is broken down by how much you are paying and how much the company is paying. So current employee deduction, I was paying $56.34 per paycheck. My company was paying $319.50 per paycheck. And then we have year to date for the both of those. Dental deductions, again, dental insurance. My portion was $1.96 per paycheck. They were paying $17.58. Vision deductions, same thing here. And then I was contributing to my pre-tax 401k. And this counts as a deduction because it's pre-tax or traditional. If you are doing a Roth 401k contribution or Roth 403b, whatever it is that you have access to, then that would not count as a deduction. Keep that in mind. That will still be on here, but it may be in a different section. But since I was doing traditional pre-tax, that lowers my tax burden that I was paying at that time. So I was doing quite a bit, $911.40 from this paycheck. My company also matched 6%. So that's what they were putting in. And then we have the totals for the year so far with this paycheck. And then you should see a summary with everything we just went through all together and then how much you actually got paid. So my gross pay was $2,965, the same figure that was over here. Also had this imputed pay. So that was that $25 gift card that got tacked on. My deductions, which were all of these here, my health insurance, dental, vision, 401k, and then taxes. So everything that was listed over here. And so my net pay was $1,508.85 after that. And then again, you can see year to date, YTD, everything totaled up. And then mine, I was always sending money to multiple accounts. So that's why you see this breakdown here. So it was just telling me which accounts this net pay was being sent to. At the time, I had it going to 4 different accounts, and it told me how much was going to each of them. That's the gist of it. As I mentioned, your paycheck should look pretty similar to that, and you've got to advocate for yourself, because the main person who's going to be paying attention to your money is you, not HR, not your boss, not anybody else. So if you notice anything wrong, speak up about it and make sure you get it resolved, because yeah, it's your money. All right. The awareness phase complete. We can check that one off. I know that was huge. I know that was a lot. You can take a break if you need to. You can come back to this tomorrow or in a couple of days, but just keep on going. Now you know what things are looking like, and you can start making a plan for things. So the next step is actually budgeting. We're going to be creating a rough budget, and throughout this course, you're going to be cleaning it up. So let's start a budget. Now you are going to make a rough budget. Keyword here, rough. This is not your budget's final form. As you go through this course, you will clean things up, adjust things. We'll get to all of that. So your budget doesn't need to be perfect. Your budget actually never ever has to be perfect. Even if you're doing it for years, there's going to be times where you don't budget enough or you budget too much, and then your actual spending isn't exactly what you budgeted. That is fine. Again, this is not about perfection by any means. And if you've never budgeted before, you will want to create a budget for every single month. It is normal for your budget to change on a monthly basis. Once you create one, we're going to go through your first rough budget. You can use that for future budgets, but there's probably going to be things that you need to adjust on a monthly basis. But this is just month one. So the budget that you are creating is going to be for either the upcoming month. Let's say if you're watching this end of June, then you will be creating your budget for July. If you're watching this at the beginning of July or beginning of August or mid-month, whatever it is, you can choose to budget for the current month that you're in if it's early enough. Otherwise, you may want to create it for the next month. As always, you can just use pen and paper. You can use my spreadsheets, which is what I'm going to be showing for this course. I think that's kind of the easiest way because it's going to add things up for you. You don't have to use your phone or any other calculator, or you can use the workbook that I provided. The templates that I use for my clients and even for myself are very simple. I like things to be clean. I don't want too much clutter going on. I don't really care for separate sections for fixed expenses, variable expenses, debts, etc. If you want to do that, you can. You'll have to find a different template, but really I don't want any friction around this. Reduce the friction, just put your income in, put your expenses in. So let me show you how to do that. You can always change the colors on Google Sheets and customize the font, whatever you want to. Also, if you're not using USD, you can change the currency. Let's say you're making the budget for July. So up here, I'm going to put July. And I'm going to change the color. I usually do kind of whatever's relevant to that month. So we have like 4th of July. And so I would do this bright blue, this royal blue, and yeah, you can change to whatever you prefer to. And we're going to be starting with your income, which is this top section here. And I want you to list any income that you have coming in for the month that you are budgeting for. So again, we're budgeting for July for the purpose of this video. And let's say that your work income is, I'm going to make it simple. Let's say it's $5,000 net. You can choose to budget with your gross earnings, but just keep in mind that if you're using your gross earnings, then you'll also want to account for taxes, any deductions from your paychecks, 401k or employer-sponsored plan contributions. That will need to be listed out as well for it to be accurate. So most people prefer to budget with their net income, and you can do this a couple of ways. So let's say you get paid 2 times in the month, sometimes 3, whatever. I'm going to put paycheck number 1, and let's say you're expecting $2,500, paycheck number 2, and also $2,500. You can do whatever paychecks you get. You can just do one, like work income, $5,000. You can split it up into weekly income. If you get paid weekly, you get the idea. If you need to add more rows, you can just select the whole row or even highlight this section and then insert cells and shift down. Or you can, if you're clicking the whole row, insert one row above, insert one row below, whichever one wherever you want a new row to go. That added in a new row so you can fit in more income sources, which is great. If you're paid hourly or your income fluctuates and you're like, I have no clue what to put here, go with the bare minimum that you expect. I would rather you be more conservative when it comes to your income. So if the lowest amount that you've ever made in one paycheck is $900, then put $900 on there. Or of course, you can think about the month coming up and be like, okay, I basically know my schedule. It will be this, and I should make $1,100 from that paycheck. Then that's what you want to put on there. Either come up with a number that, you know, to the best of your ability, or go with the lowest that you've ever earned so that you're not expecting more income than you actually get. And that can really throw off your budget. If you make money on the side, you have a second job, put that on here too. If you know the money is coming in for the month, you want that in there. Again, same idea, be conservative if you're not sure. Let's say for this person, they do some pet sitting. And so they know they're going to make $200 in the month. So we'll pop that on there. If you receive Social Security, disability, any other government benefits, if you get child support, alimony, put that all in there. It's money that you will be budgeting with, okay? Unless it goes towards something else and you don't want to count it, that's fine. You don't have to. But whatever money's coming into you, that's what you want in this section. And then you'll notice that there's a couple of rows beneath that, underneath total income, and then there's like a second total. And sometimes people get confused by this, but I like to have that. So this is like actual income that you are earning and receiving in the month that you are budgeting for. And then these cells here would be money that you will be working with in the month or expecting to work with in the month, but it's not actual income. So this could be you pulling from sinking funds or savings, and we'll talk about this more later. But if you're pulling, let's say you plan to book some travel in the month and you have a travel sinking fund. Well, that's not really income. You've already saved up that money. So if you're pulling $500 from that travel sinking fund, you would put that here. I also love to take advantage of the notes feature in Google Sheets. So if you right click or double click, go down to insert note, and then you could say 500 from travel sinking fund, SF. Whatever it is that you want to do. I think notes are awesome to take advantage of because I don't know about you, but I forget what I spent money on, what I was thinking a week ago. So it's really helpful. So that's one example. And I'll show you for this budget, I'll make sure to include some travel spending of $500. So this makes sense. You could also put reimbursements in here. So it's not actual income. It's money you've already spent, but you're expecting that to come in. And again, if you need more rows, then you can add those in. Another big thing is rollover money. So about half of my clients like to account for rollover money and the other half does not. Personally, for years, I went without counting it, but now I do factor in rollover money. And what that means is just money from the previous month rolling into the new month that you are budgeting for. So for this example, it would be money from end of June that's left over in your checking account or spending account, whatever, that rolled into July. So you could also work with that money. The important thing to keep in mind, though, is if you do include that and you want to keep that rollover balance month over month, you want to keep a cushion in your checking account, you want to make sure you still keep that amount left over after your expenses are accounted for. So if you put your rollover on here, so let's say you have $1,500 still in your checking account, or that's what you think it will be at the start of July, then you can put $1,500 in here and this is all totaling up. So $7,200 to work with in the month. I'm going to explain the expenses more as we go through this, but you're going to list all of your expenses. That's going to total up here. And this number here will show the difference between your expenses and your income for the month. And you want this to, if you do want to keep that cushion, you want this to stay at $1,500. So just keep that in mind. If that sounds confusing, then don't worry about it. And for the purpose of this course and going through this, I'm going to keep it out. So we're just going to take that off. And if you're currently writing out your income, not using my spreadsheets, then be sure to add your income up. Okay, so we'll come back to that. So for this example, this person has $5,700 that they are expecting to earn and have to work with in the month of July. And so now we need to make the budget based off of those numbers. So we'll come down here and you're going to list out your expenses and how much you know it will be or expect it to be for the month of July. Now, the way that you organize this is completely up to you, but keep in mind, as I mentioned before, I want you to reduce the friction. Don't give this too much thought. Just start listing all of your known expenses. I have a sheet that lists budget categories with many different expenses that would go under those categories. So if you're like, I can't think of anything, then reference that. You could start with fixed expenses, then move on to variable. You could put them in order of needs, wants, savings, whatever you prefer, or you can just, start listing them. So I'm going to plug in a bunch of things so that I just have this as an example. You can also get creative. You can insert emojis, add colors if you'd like to. I'm going to pop up a couple of examples of clients that I've worked with. I think adding in your own personal touch makes it a little bit more fun and exciting, because I know budgeting isn't super exciting. And I know I keep saying this, but keep in mind that you're budgeting for a specific month. So reference that year at a glance tab that you had worked on before. And if there's anything that is coming up in the month, I had filled out some examples in the last section, but let's say for July that you need to book Airbnb for a trip, and that's where that $500 travel sinking fund comes in. So that's what I'm going to put. Okay. So I reference this year at a glance. I'm like, okay, I've got to book the Airbnb. And then you'll also just want to give some thought to all of your expenses based on what you have going on. If you're like, oh, I'm hanging out with a friend, I probably will go out to eat X amount of times. And this is where your spending data comes in handy. So if you have the last 3 months of data, you can also reference those numbers, because it's going to give you a better idea of how you actually spend your money, especially for things like groceries, food out, personal spending, fun and entertainment, the categories that people usually don't know how much they are spending. But I'm going to start filling this out and kind of talk through things as I go. You put your mortgage, your rent, let's say it's 19. These are just made up numbers. You can also choose to combine things for simplicity, or if it's too overwhelming for you to separate things out, then you can combine. So instead of electric, gas, water, you could just put utilities and kind of total everything up based on what you know, or you can separate them out. So let's say electric is 200, got water, gas for the house, Wi-Fi, don't forget Wi-Fi. Again, reference that budget category sheet because it's easy to forget some things in your life. Your phone bill, let's call it 90. And usually this is what things look like for people that I work with. So they start with the housing, then they'll move on to transportation. Let's say you have an auto loan. Let's call it $500. Have car insurance if you're paying it monthly, or if you need to pay your 6-month premium, whatever it may be, let's call that 160. Let's say gas for your car or fuel, whatever you want to. It's been more expensive. Let's call that 200. If you forget anything, again, you can go back in and add a row. So let's say I want to add a household line item. Insert cell, shift down, and then you will want to drag this formula down. So when you click on a cell and hover over the little circle in the bottom right-hand corner, click and drag, and that's going to bring the formula down and it'll be no problem. So let's say you wanted to also budget for household, $100. That's like toilet paper, cleaning supplies. You don't have to do that. You can incorporate that into groceries. We can put groceries next. Let's call that 500. Can put food out next. Let's call that 200. If you have children or pets, list those expenses in here. Again, you could just choose to have that under one line item like childcare or children, child, or you can separate it out by daycare and children purchases, children clothes, whatever it is that you want to do. You can get as granular as you want to. I'm just going to put pets and let's say budgeting 200. Let's pop some fun and entertainment on here. Maybe you'll go to a concert or buy a concert ticket or go to the movies, have a night out, whatever it may be. That is separate from food out. Subscriptions, don't forget your subscriptions. Same thing. You can put subscriptions as one line item and add everything up, or you can split them out. I will split them out. So let's say you have Netflix. Let's say Spotify. All of these have been going up lately. Let's say you have iCloud. That's a common one that my clients always have. Health, wellness, or health and beauty. You can have health as one, beauty as another, getting your hair done, nails. You could have that if you wanted to. I'm just going to call it health, wellness and put this at 200. Let's say also in July, there was like your friend's birthday and you want to spend about $50 on that person. So, okay, you're referencing the year at a glance and then come back here. So you're like, okay, I have to buy some gifts. That'll be $50. All right. And then let's say you have debt that you need to account for. So credit card 1. And I would be more specific. Like I would call it Chase. If you have a Chase credit card, let's say that minimum payment is $50. Let's say you have a Capital One credit card. That minimum payment is $75. Maybe you have a student loan. Before I add that, I want to add some rows here just so I have more room. Again, I want to drag this down so the formula is all included. Okay, let's say you have a student loan that you have to pay, and that's $250. And then you're like, okay, after that, I would like to save to my emergency fund. I would like to add to my car maintenance sinking fund. You don't even have to know these details yet, but you get the idea. You just add in everything that you need to absolutely spend money on. And then if there's anything that you want to, you can pop that in at the end and you can always come back to this and adjust. So don't stress about it. Again, if you have that spending data, that spending history, these numbers are going to be easier for you to come up with. But if you're going into this blind, like you have no clue, genuinely no clue what you spend on these random categories, then I would suggest being a bit more generous just so things don't get too thrown off. So if you're like, I genuinely have no clue what I spend on groceries, all right, let's call it $700 then. Or if you have a number that you want to aim for, don't go too small because you don't want to be unrealistic. You want this to be realistic. So if you're like, I really want to stick to $450 as a budget for groceries, you could put that, like whatever it is that you want to aim for, or maybe go up to $500 because you're like, I want to aim for $450, but more realistically, I think it's going to be $500. Same with food out, same with, anything that is, you just have no clue what you would be spending on it. Then I suggest being a little bit more generous, increasing the amount that you're budgeting. Then as the month actually arrives and the days are passing, you will be tracking your spending. So you will now have data to reference for August, September, October, so on and so forth. As you get things added, you can get more creative. Honestly, for just about everybody I work with, I like the debts. Even this is what I did with myself. I like debts to be in red and savings in some sort of like blue or green color. So that's what I always like to do to at least differentiate those. And same with this auto loan up here. Turn that to red. But as you saw from those examples before, you can add emojis, add colors, change this up as you need to. You can also go through and add due dates for things. So if you have the mortgage or rent, whatever, of course, that may be due on the 1st of the month. Electric is due, you could say, 3rd of the month. From the last section, you do know the due dates of your credit cards and debt. So I want you to throw those in there, whatever they are, just making these up. I think it's good to just have these so you know what to expect, what's coming up. One rule that I have for my clients is no miscellaneous category. So I'm going to make that a rule for y'all as well. Everything can be categorized. Even if it's like random shopping at Walmart, then put a Walmart category on there. Actually, one of my clients does that. He puts Walmart supplies, and that could encompass groceries, clothes, personal hygiene products, but if he goes to Walmart, it just goes in that category. One line item I didn't add in here, which I'm going to, is personal spending. So that's like clothes, shoes, books, anything, electronics even. If you have a business, then put business expenses in there or work expenses. Let's just say 100 for personal, okay? And you'll see that these numbers keep changing. So everything that we've listed here, if you're using my spreadsheet, it will total up. Just double click it. And if you double click, make sure all the numbers are being pulled in so you have the right number. If you're using pen and paper, add up all of your expenses and get your total. And then you want to subtract the total of your expenses from the total income or money that you are working with. Oh yes. Also for this example, I said I would put in travel to show you what that looks like with the sinking fund. So travel 500. And so that's going to change things quite a bit. So this travel of $500 to book this Airbnb that we need to book, right? This person had $500 or more in their travel sinking fund. So that's where this comes into play. So 500 here. If we didn't count that, then they would be negative for the month. And that is not ideal. We'll talk about that in just a bit. So we're going to put that 500 back. And so as you're adding everything, if any of it feels overwhelming, or as the month begins and you're like, I can't keep up with tracking food out from groceries, from coffee, from whatever the case may be, then simplify it. You can chunk things together, kind of like that Walmart example that I was going with. If it feels too difficult to track the groceries from the food out from the coffees, just make one line item, call it food, and just make sure you're tracking everything. And once you feel more comfortable with this, you can get more granular later. The most important thing is you are doing this, and whatever it is that will help you to get this done, that is what I want you to do. If it needs to just be like 10 categories and that is it, great. But now you need to track your spending. But we're not quite done with your budget, because now I want you to take a look at things more closely. And once you've taken the difference between your income and expenses, you are going to fall under one of these three. So first one would be you're in the positive, like this person is. $12.04 is left over. That is good, but there's probably some things that they could cut out or reduce in their budget. So that way they could make more progress on their debt or add some money to savings, because we didn't even add anything to savings yet. So we'll talk about that. You may have absolutely nothing left over to budget. So this is zero. You've budgeted everything. That's called zero-based budgeting. Kind of the idea that kind of what I want you to get toward. And that means that every dollar that you are bringing in has a job. It's going toward what you need to pay for, your debts, your savings. So that might be your situation. Or this number could be negative. So let's say we had another 500 of expenses on here. This is a negative number, and everything I'm about to go over, it is most important for you to listen up and try to cut and reduce expenses. But no matter which area you fall under, I want you to try to reduce and cut expenses. So let's talk about that. And this is kind of where I come into play as a financial coach when I'm working with people. I want people to spend their money how they want to spend their money. I have a very chill approach to working with clients, making a budget. However, if you're telling me I want to be debt free, but then you are making the choice to spend X amount on food out or travel, fun and entertainment, personal spending, anything that's not necessary, that is on you, so you need to think of your goals and what it is that you truly want and what you're willing to sacrifice. You don't need to sacrifice anything if you don't want to, but just know that there's an opportunity cost with that. If you're spending more on food out, that means less money going toward debt, less money going towards savings. And obviously that's just an example. So any expense versus paying off debt, saving, investing, you get the idea. Also, keep in mind that these cuts to your expenses and changes in your spending habits, it might make you feel uncomfortable, but chances are you're probably already uncomfortable. If you are watching this and feeling stressed about your numbers, you're already uncomfortable. If you are ignoring, avoiding your finances, you are already uncomfortable. Now this is just going to be a different version of uncomfortable, but it's not permanent. So I'm kind of going to walk through this as if this person was my client, right? So let's start with the income. And now this is something that you may not be able to control immediately. We'll talk more in this course about how to increase your income, especially quickly or like in small amounts. But let's say after I speak with this client, one of their tasks is to try to increase their income for the month, and they're able to get another pet sitting client. And so it's just like a 2-day cat visit or something like that. So instead of $200, they're increasing this to $250, right? So before, let me go back, before the leftover amount was $12.04. But if they are going to increase their income by $50 from pet sitting, then now they have $62 to work with instead of that $12. Several line items they wouldn't be able to change. You can't change the mortgage, electric, water, gas, etc. Maybe you could call internet provider and see if they have any discounts, or maybe even switch, see what's in the area. And let's say they were successful with that and they got a tiny little deal, even just $75. So again, this has increased to $67. Let's say also they decide to switch their phone plan. Instead of $90, they switch over to something like Mint Mobile. I personally use Mint Mobile. I pay for it annually, which comes to like $260 in the year. But even if they could just get this down to like $40 a month, that's a savings right there. More money to work with. Household, we can leave that. That's fine. Auto loan, we can leave that. Car insurance, shop around for car insurance. I have a free tool, I will have it linked down below, that you can use to compare providers, car insurance providers. It's free to use. You don't have to enter your name, your email, phone number, none of that. You're not going to get calls, but it will ask questions like where you live, if you currently have car insurance, and it's going to give you the best suggestions. And then you can go and shop around through those sites individually. But I myself use that. I also have my clients use it, and usually it does provide you the best options and you can save there. So let's say for this person, they were able to find a better rate and get it for $140 a month instead. Gas, we'll leave that. Groceries and food out, we'll leave. But if this person decided, you know, I really want to cut back on my food out spending, maybe you could reduce that to $100 in the month or $75. We'll leave pets. Let's say for fun and entertainment, they're like, you know what, I really, really want to pay down this debt and I can do things for less money. So instead of $150, I'm going to budget $50 for fun and entertainment. Review your subscriptions. Maybe this person decides, I don't really use Hulu. We're going to take that out. So let's take Hulu out. Keep the other ones. Health, wellness, we'll leave that. Personal, we'll leave that. The travel, they've got to book that and the sinking fund is going to cover it. The gifts we can keep in. And now you see what has happened. Instead of $12 left over at the end of the month, they have $249, and you can now budget that based on your goals. So let's say for this person, they really want, maybe their emergency fund is good. They've gotten it to a point where they feel pretty comfortable with it, at least as just a starter emergency fund. So they do want to add to their car maintenance sinking fund. So they're going to do 50 there, nothing to their emergency fund. And they still have, we'll just call it 150, leave a little bit of a cushion. So their top priority, for example, is their Chase credit card. And so we're going to add an extra $150 to the Chase credit card. And that will speed up paying that off. And usually I like to change the color of what they're focused on. So this is their top priority. That is now getting extra. We've left a tiny little cushion. So in case they go over budget in one area or another, then it's fine. But that's the idea behind this. And if there's anything in your life that you are spending money on that you can cut completely or reduce, then look into that. Even if it's just temporary. If you're used to getting your nails done every single month, can you pause on that for 3 months? Getting your hair done, can you pause on that? Any personal spending? Are there apps or subscriptions that you have that you don't really use them, or you could go without them for some time and resume them later? You get the idea. But hopefully by going through everything, that frees up some more money in your month, in your budget, and then you can apply that toward your savings, your debt, investing, whichever goal that you're working toward. We'll talk more about how to figure that out, what you should prioritize in just a bit. And again, this isn't something that you need to figure out right this very moment. It's just like getting an idea of like, okay, I should shop around for car insurance. I'm going to call my utility companies and see what I could lower. I'm going to switch phone plans, et cetera, et cetera. And within a few days or by next week, these things should be situated, and then you can come back and adjust your budget. But for the most part, you should now have your rough budget ready to go, and we will continue to clean it up as we go through everything. And I know I've brought this up already, but now you need to track your spending. So you're probably watching this before the month that you budgeted for has begun. But once it's July 1st, you're like, all right, this month I am tracking. Now, what I want you to do is track at least weekly. So for most of my clients, that means on Sunday or Monday morning, they have tracked for the last week. I hold them accountable to that. So that's what I do as a coach in addition to the calls with them. So if you need that extra accountability, I do have spots open for coaching, or you can join my school community, because I also send a reminder every Monday morning to log your spending from the last week. And this is like a community effort. So if you need that extra accountability plus some extra stuff, check out my Budget and Build school community. Both of those are linked down below. And personally, I track in real time. So I'll go to the grocery store and then usually once I get home or right in the car even, pull out my receipt and I log my spending. Or if I buy some dog food, chewy.com, PetSmart.com, whatever it is, I go to my spreadsheet, log how much I spent under my dog category. I don't expect anybody to do daily or in real time like I do. I suggest at least weekly because otherwise it gets confusing. You're probably going to fall off track and not build the habit around it. I suggest making a little ritual out of it. It doesn't need to be anything crazy or fancy, but make yourself a cup of tea or do it on Monday morning while you're drinking your coffee. You've got like jazz playing or your favorite TV show on. It's not something that should take you hours and hours. This should just be like 10-20 minutes max of your time going through everything that you spent and logging that in your spreadsheet or on paper, whatever you prefer to do. I was doing this example in my simple budget tracker. So with the templates provided, I also have a weekly budget tracker and it's literally the same thing. So let me copy and paste. It's literally like so. So we've got July in there and then we're just going to copy over those expenses and how much was budgeted. By the way, if anything in your sheet is messing up, like things are not calculating correctly, then you should be able to reference another sheet and get the same formula, kind of work backwards and figure it out. If you absolutely cannot figure it out, then you can email me or join my school community and I'll go in your spreadsheet and fix it for you. But I can't guarantee that I will get back to every single email, but I will try my best if you absolutely can't figure it out. So yes, we've brought this over here, right? And for most of my clients, I have them using this weekly layout because it's a bit easier to kind of picture things. And so for the example of July, I'm going to put the dates across the top. So it's just by the week. Usually I go from Monday to Sunday, but July starts on a Wednesday. So we're going to do the 1st through the 5th. So Wednesday through Sunday, then Monday the 6th through Sunday the 12th, Monday the 13th, through Sunday the 19th, Monday the 20th through Sunday the 26th, and then we will pop in the 27th through 31st. And so if you spend any money on the 1st, it would go under, the appropriate category and under this column. If you spent money on the 7th, then it would go in this column, or the 10th under that column as well. On the 14th, that would go here. This is sometimes easier for people to fill out based on the date. And if you're doing it weekly, you're tracking weekly, then it's sometimes cleaner. So it's up to you what you want to do. Y'all know that in my videos, I still use this template. It's basically this, just a little bit different because of how my business is set up. I like having the one column and I just add everything up. And the way that you do that, so let's say you go for multiple grocery trips in the month, of course. Maybe the first trip is $75. So you're going to put equals 75. And then next week you spend $85. So you're going to come in to the same one. You can double click it or it'll be right up here too. Add the plus sign, $85. Enter, and now it's totaling up. And you can keep on doing that. So keep adding to it, plus 100, et cetera, et cetera. And just like you're tracking your spending, you want to track your income as well. So under the actual column for the income section, you'll want to put your actual income. So if paycheck number 1, it comes in, again, with this, you could also put dates. So if it's like the, let's see, maybe the 10th of July, then on the 10th of July, you're like, okay, I got paid. It was $2,500, so on and so forth. Let's also put, let's say they're getting paid the 24th. You got paid from your pet sitting. So far you've got $150, then you got another $50, so on and so forth. So as your income comes in, you'll want to log that here. When you pull from your sinking fund, you'll want to log that here as well, because these numbers here are going to interact with this number down here. So this will be your actual spending throughout the month. Same with over in the weekly budget. Actual will be on the far right, but it's also all going to be totaling up at the bottom. So make sure you're filling out your income and your spending. And the way that the difference columns work on both of these templates is if you are right on budget, so you pay your mortgage, it's $1,900. That will turn white. So anything equaling 0 will turn white. If you go over budget in an area, let's say, okay, you spent another $500 on groceries, that will turn red. So over budget will go red. And if you are under budget, you stayed within budget, let's say you spent $185 on gas, it will stay green. So that's how that works. And you can kind of keep an eye on the categories that are going over budget, especially if it's early on in the month or midway through the month, and you're like, okay, I need to keep an eye on my groceries and try to reduce this next weekend. I also want you to keep the red in there. I want the negatives to stay in there. So once the month begins, I don't suggest touching the budget unless it's like something that's fixed, like your car insurance got changed and you know for sure that's going to be different. So you can adjust that one. But if it's something like groceries or food out, personal, the variable expenses, I wouldn't touch it because you want to see where you're overspending so that you can clean up your budget for the following month. And now I do get a lot of questions on how to use this for the following month. So there's a couple of options. What you could do is have a new tab for every month. That's going to kind of take up, there's going to be a lot of tabs throughout the year, but many of my clients do that. So let's say that we call this, instead of simple budget tracker, we're going to call it July 2026. By the way I did that was double click, rename, and you'll be able to rename it. Or you can even like double click on the tab and it will highlight and then you can edit it. Let's say you want to create a budget for August. You can go in and duplicate this tab. We're going to rename it to August, or you could just do AUG, whatever you want to, 2026. I'm going to change this up here, of course, because it's no longer July. Again, I like to change the color. So go in and change it to whatever you see fit. We'll go with yellow. And then you'll want to clear out any of the spending and actual income. So you can probably keep a lot of these things, but you would take out the actual spending and then you would adjust as necessary. So maybe for August, you're not going to have this travel sinking fund to pull from. So we're going to take it out, delete the notes. Maybe pet sitting will be lower, so you adjust that and then, go through the budget the same way. Or you could do what I do, which is kind of already reflected here, but you see how there's July and then there's another section over here for a new budget. That's what I do. So copy, paste. And the way that you do that is I'm going to go with this one. So let's say it was called 2026 instead, and you want to just copy everything here. So all the way up and down, just highlight A through D or whichever cells you need to, copy, and then paste it one column over. So paste that there. I like this column to be like a divider. And so I'll usually put a dark gray and then just make it smaller so it acts as a divider. And then you can do the same thing. So change the color to whatever you want to. You don't have to if you don't want to. We'll call this September. And that's how you would differentiate. This is what I do. I like it all to be on one tab, and it's easier for me to reference the last month, and that's just how I prefer to do it, but do what works best for you. You don't need to make a new sheet every single time. This is literally just copy pasting. Sometimes the formulas and the conditional formatting will be thrown off because Google Sheets gets a little weird, but everything can be fixed. If something is broken in Google Sheets, it can 1000% be fixed. So again, reach out to me, join my community, whatever you need to do, and I will try my best to help. And I know that was already a lot, but we're still not quite done with your budget because we're still going to talk about debt and savings and even investing and how you should incorporate that into your budget, because a lot of people don't know what they should be prioritizing or how much to save before paying off debt, or should they even save before paying off debt. So we're going to talk about all of that. Keep your budget close by because we'll still be working on it. But seriously, congratulations on being aware of your numbers and putting your rough budget together. This is huge. And now we can kind of take a look at all of your finances a little bit deeper and figure out what you need to do. So next up, we will be talking about debt and your credit score. So let's get to that. My favorite topic ever, debt and debt payoff. I am very passionate about living a debt-free life and encouraging people to pay off their debt, especially consumer debt, because being debt-free is truly freeing and it allows for a lot of options in your life. However, I do not think you need to give up joy and enjoying your life throughout your debt-free journey. You will need to make some sacrifices if you want to accelerate your debt payoff, but you do not need to be miserable. And from the first section of this course, you already have the information about your debt. So So make sure you have that handy. How much you owe, who you owe, the interest rate, minimum payment. Now you want to come up with a debt payoff plan. But before we even do that, I want you to try to shape your debts, if you will. And what I mean by that is that there are a number of things that you can do or try to kind of manipulate your debt, especially the interest rates. First, I'm going to focus on credit card debt. So if you have credit card debt, the bare minimum that I want you to do is call those credit card companies and ask for a lower interest rate. We're going to start with communication because you'd be surprised how far this can go. Here's all that you need to say when you speak with a representative. You're going to get on the phone and they're going to say, "Hi, how can I help you today?" After you confirm your identity, all of that stuff. And all you say is, "Hi, I was just wondering if there's any way I could have a lower interest rate on my credit card." So you're just starting with a question. You don't even need to explain anything, or yet you don't have to explain why you're asking for this. Just ask if there is any promotion or something that you could have to lower your interest rate. They might immediately reject you, and that's fine. If you're comfortable, you can push back a little bit and say, "Are you sure? Is there somebody else I could talk to? Or is there something even temporary? Can I lower it by 5% or down to 9.99? You get the idea. You can just kind of talk your way through things. But if they don't budge, then that's fine. You can try again in 3 months. So just make note of the date when it was on your spreadsheet, on your workbook, piece of paper. Take note of the date and then put in your calendar 3 months from now that you are going to call and try again. But if you're someone who has a lot of credit card debt or is having a hard time keeping up with your minimum payments, then I want you to call, explain your situation, and see if there's any hardship program available to you. So with this, you are going to have to explain more of your situation. You may get emotional, you may cry, you may feel anxious, all of the things. But if you are able to get one of these hardship programs, it literally might save your whole financial situation. So I highly encourage you to do it. Push past that anxiety. So again, the person on the phone may give you an immediate no and not give you any type of options. They may ask more information, like why it is that you need a hardship program, what's going on. This could be that you've recently lost your job, or you recently had a baby, or you're having a hard time keeping up with your bills and XYZ. Whatever your situation is, that's what you are telling them on the phone. These are real humans on the other line. So just keep that in mind. And they may give you a few different options. So sometimes it will be just like one option and you can just take it or leave it. Or they could give you like 3 different options and you have to choose. One of those could be lowering your interest rate for 6 months or 12 months. And maybe your interest rate is 25% and they're like, okay, we can go down to 14% for 6 months. Do you want to accept that? They may offer a temporary pause or reduction in payments. For most people, I wouldn't accept this one unless it's like you really are struggling to stay afloat. But this isn't really changing anything. It's just stopping your minimum payments. And then after the 3-month period or 6-month period, you are just going to owe so much more because of the interest rate. So for most people, I don't recommend taking that option. Something else they might offer is closing your account or even temporarily closing your account. 0% interest for that time. Either if they close it permanently, then it will be, 0% until the loan is paid off, and they will give you a set minimum payment on a monthly basis. Sometimes it's different from the one that you already have. I do encourage you to take that one, especially if it's a card that you don't care about much. Yes, your credit score is going to decrease a little bit at the beginning because you would be closing an account, but it's probably going to do you a favor because now you can't use that card. You're going to get 0% interest. You're going to have set minimum payments. And this is it's going to speed up your debt payoff overall and give you a little bit of a break. And imagine you have 4 or 5 different credit cards. You give all of them a call, and out of those 5 credit cards, 2 or 3 of them put you into a hardship program, and now those 3 have 0% interest. That's going to change your situation completely. And that's what I mean by shaping your debts. And that's why we're not choosing a debt payoff plan yet, because I want you to make these changes first and then decide. So depending on your situation, the types of debts you have, your monthly cash flow, what you're comfortable with, if you're willing to close an account or not, you decide what it is that you want to do. And hopefully more of you will see that there are options out there for you. If you do take action on this, which I really hope you do, then please comment down below the options that you were given, or even if you got rejected, please let us know in the comments. You could also consider debt consolidation, and this is when you're combining multiple debts into one debt. And I'm going to pull in my whiteboard for this. So debt consolidation is something that I want you to consider only after you've taken that first step. You've called the credit card companies and asked for some sort of promotion. If nothing works, then you can consider debt consolidation, and we'll get to balance transfers in just a bit as well. But there are some people who debt consolidation is not a good fit for. But let me explain it first. So these are just some example debts. 2 credit cards, both have high interest rates. We have a student loan and we have a car loan. With one type of debt consolidation, this could be you taking out a new loan. We'll call it a personal loan. And let's say you get approved for $12,000 and the interest rate is 14%. Well, that works great for this situation because you can pay off credit card A and credit card B, because that's a little bit under $12,000. And instead of 29.99%, 24.99%, and 2 separate minimum payments, those 2 debts will now be under this personal loan. So those will go away. You'll only want to use what you actually need. So it would technically be $11,600 that you owe, but now at 14%, and you're going to have just 1 minimum payment. And let's say that minimum payment would be about $350 per month or so. Very similar to what you were paying before, but now things are a little bit simplified because you just have 1 payment instead of the 2. And you also have a much lower interest rate. Still high, but much lower than what you had before. And now be careful with these because sometimes you may take out a loan and they're like, okay, your new minimum payment, it just depends on who you go with. This could be a personal loan. This could be a HELOC. We'll talk about balance transfers. That's a type of debt consolidation. But if this minimum payment is really low, like it ends up being $200, then if you look at the total repayment cost after factoring in the interest rate, you should be able to see this information when you take out the loan. Then it may cost you $4,000, $5,000 more than this $11,600, and you potentially could have just paid less by keeping those credit cards. Just pay attention to everything and don't be super quick to jump into these. It's really, if you're like, okay, that's actually going to save me money and I have a plan to tackle this and take care of it as soon as possible. Also, sometimes when you do a Google search for debt consolidation loans or anything with debt consolidation, you may get an ad for debt relief or debt settlement. That is not the same thing. I personally do not recommend going down that route. It often involves you stopping payments and then they will take care of negotiating your debts after they've gone into collection. So your credit score is going to tank if you choose that route. And I believe that just about everybody can manage their debts on their own. So please be very careful about that. As for those who would benefit from debt consolidation, if you have high interest credit card debt, then you may be sure that you're getting a lower interest rate than your current debt. So for this example, consolidating your car loan into this personal loan would not be ideal because of course your interest rate is lower and going up to 14% would just be crazy. It can also benefit you if you struggle with multiple payments. So if you have 2, 3, 4, 5 different credit card payments and you want to just put that into 1 or 2 different debts, then it's a little bit easier for you to manage. It would also be ideal if you have a pretty good credit score, somewhere in the 600s. If you go to a website that puts together a list of consolidation loans or personal loans, then it will usually tell you the recommended credit score. Not guaranteed, but if you're in like the 500s, you may want to first pay off some credit card debt before applying for a personal loan or taking out a HELOC, anything of that sort, because you may get rejected. It's going to tank your score a little bit more and you're going to have to wait a few months anyway. So wait until your score gets to like 650 to 700, and then you can probably start applying. So that leads me to who should not consolidate debt, and that would be if you have a low credit score. You may get approved for a loan, but it may be a pretty high interest rate and it's not going to save you that much money. So again, just pay attention to all the numbers. I also wouldn't recommend it if you have poor spending habits and you are like, okay, I paid off these 2 credit cards with this personal loan. Now I have $12,000 free on these credit cards so I can spend more money. And that happens a lot. So if you feel like that's what you would do, then just focus on paying off your credit cards. And then maybe you can close a couple of them as you pay them down. We'll talk about that later. I also usually don't recommend consolidating federal student loans unless it's a direct consolidation loan. So it's going from federal student loan to federal student loan, because federal student loans have benefits. If you can't make payments, you can defer those payments. You can go into a hardship, forbearance, whatever it may be. For example, during the pandemic, those with federal student loans, interest went down to 0% and we didn't have to make payments. And those who had private student loans, their interest was still accruing and they had to make payments. And I know I've kind of already touched on this before, but just make sure you're looking at all the numbers. And if it's extending the term of the debts, just because you have a lower minimum payment, it doesn't necessarily mean it's a good deal, because this could end up costing you thousands of dollars more and you would have just benefited from keeping the credit card debt. So do the math on it and try to pay it off within a reasonable time so that this interest rate savings is actually worth it. So before consolidating, definitely call your credit card companies or whichever loans that you have and communicate first, see if there's any options, and then you can move on to these ideas. Check your credit score before applying. If it's too low, work on tackling some debt for a couple of months. Your score will increase and then you will probably get approved for a loan and it will have a better interest rate. When you do go to look for a loan when consolidating debt, be sure to compare interest rates and fees. And then if you consolidate, after consolidating, avoid adding new credit card debt. I wouldn't use those until all your credit card debt is paid off, all your consumer debt is paid off. As promised, we're going to talk about balance transfers. This is a type of debt consolidation, and a balance transfer is when you move existing debt to a new card with ideally a 0% interest rate for a set amount of time. So let's say you get approved for a $4,000 credit card, a balance transfer card, and they are offering you 0% interest for 21 months with a 3% fee. Balance transfer fee usually is 3% to 5%. So with these examples, this balance transfer card could completely cover this $3,200 credit card. And instead of paying an interest rate of 29.99%, it'll be 0% for 21 months, which will result in a huge amount of savings in interest. And since the balance is only $3,200, that's the amount that you are transferring over, right? $3,200 plus the 3% fee, which is about $96. And so now the amount that is on this new card, $3,296, give or take. It will, of course, give you a minimum payment for this amount. It's probably going to start somewhere around $90-something or $100. But if you wanted to pay it off within the 21 months, then you would need to make payments of about $157 monthly. And that's for you to guarantee that you will pay it off within the 21 months, but you don't necessarily need to do that. If you just want to pay the minimum, focus on your debts that have an active interest rate, then move on to this one. I usually recommend that. Sometimes people get really hung up on this time period and they're like, I need to pay it off. Otherwise the interest rate is going to increase like crazy, which yes, that's true. But keep in mind that the interest rate before was almost 30%, right? But now you're paying 0%, which is a huge savings for a long period of time. And even if you don't pay it all off by the 21-month period, it will be a smaller balance. So yes, the interest rate's going to go up, but it's not going to cost you that much in interest. And then you can shift gears, focus on that at that time. It very much depends on the situations. We'll talk about it more with the debt payoff plan, but if you're not sure what to do about it, reach out to me, join my school community and ask in there, and I can help you to come up with a plan, because sometimes people need a second set of eyes on things and somebody who's emotionally removed from the situation and not just focus on deadlines and all of that. So similar to debt consolidations in general, those who would benefit from a balance transfer are those who have high interest credit card debt. You also ideally want to have a bit of a higher credit score. 650 and above will probably get you approved, or you may even get some offers through your email or in the mail, and you could take advantage of those. It may be with a bank that you already are banking with. You'll probably also feel more comfortable if you have a solid plan to pay off the balance within the promotional period. But as I just talked about, that is not required, because no matter what, you will be saving money with this. Well, not no matter what. We'll talk about that. And sometimes doing balance balance transfers can simplify things, simplify your numbers, because if you get approved for a larger amount, then you could maybe move 2 or 3 credit cards onto the new one and just have one payment to worry about. But it, again, depends on your debts. I do not recommend doing a balance transfer if you have a spending problem or feel that if you free up this $3,200 on this card, then that means you can spend money. I don't want that to happen. This is moving money around so that you can save money, not for you to go into further debt. I know I already talked about this, but I just want to reiterate it. But if you do not feel confident that you will not see this as a spending opportunity, then don't do any of this. Just keep your debts as they are, work on paying them off. I also wouldn't do a balance transfer if the fee outweighs the savings. So sometimes people try to do too many balance transfers and then they have like smaller debts and the fees getting tacked on are costing you more than the interest that you would be charged. So look out for that. Do the math, calculate everything before actually transferring anything. If you have bad credit, hold off on applying for new cards. Pay off some debt first, increase your score, and then you can apply. It'll take just a couple of months. And if you plan on applying for a big loan soon, such as a mortgage, then I would hold off on debt consolidation or balance transfers in general, because this will lower your score temporarily before it increases. So before doing a balance transfer, check your credit score. Find a card with a long 0% APR period. These days, there's some great options out there. You'll probably see offers with 0% for 12 months up to about 21 months, sometimes longer. Make a debt payoff plan so you're confident you can pay it off before the promo expires. We will talk about this in just a bit. Again, not required. Do the math, make sure the numbers make sense and the fee isn't going to eat up the interest rate savings. If you do choose to do a balance transfer, I would avoid any purchases on this new card, because just because you have this 0% offer, that's for the balance transfer. Oftentimes these cards do not have an intro rate, so any new purchases will potentially be getting charged interest. So that information should be on the application page, but for the most part, you just don't want to be adding new debt in general. A common question I get too is, once you've paid off this card with the balance transfer, should you close it? Not necessarily. You can if you want to, but just know that it will probably temporarily lower your credit score depending on the age of that credit card that you had. But yeah, we'll talk about that in just a bit as well. I do briefly want to talk about how to find these debt consolidation loans or balance transfer offers. First option is to just do a Google search. And there are several websites out there that consolidate this information. So this would be like Forbes Advisor, NerdWallet, Bankrate, and they give a list of different options. And what's great about these is you can compare things. So it will usually say the recommended credit score that you should have before applying, the interest rate, the terms, all of that stuff, and you can compare and see what works best for your situation. You may even have some pre-approval options, so pay attention to your email. If you have like a Chase credit card already or Bank of America credit card, you may be getting emails that say, hey, take advantage of this balance transfer offer. You are pre-approved. And so if you're pre-approved, you're more than likely going to get approved for it. And then you can it'll be even easier for you to do the balance transfer, for example. You could also be getting stuff in the mail, and it will also say that you're pre-approved, not 100% guaranteed, but more likely for you to be approved. Credit Karma app is another great resource. It's a free app. They often recommend credit cards, so I don't want you to go crazy and open all the credit cards because they're just recommending it, but you should also see balance transfer options available. And based on your credit, they'll usually let you know if you're likely to be approved or not for those cards. And then as for specific banks, Citi, Discover, and Capital One all have great balance transfer options. So they also usually have a pre-approval website, so I can have those linked within the workbook, and I'll have them linked down below as well. You'll probably also see those 3 banks suggested in those comparison websites I was talking about before, but you can go directly to these pre-approval sites and enter in your information. It's not going to hurt your credit score, and they'll let you know, hey, you'll likely be approved or you probably won't. And then that will prevent a ding against your credit. So I do recommend going with one of those or somewhere where you can see if you're pre-approved or not. Now, if you have student loans, you could consolidate these if you want to. You could do a balance transfer with some of your student loans if you wanted to, but just be really careful with that, because oftentimes student loans are like 7% and below of an interest rate. And if you're doing a balance transfer, yes, you'll get 0% and save a little bit of money, but there will be a fee to consider. And then if you do not pay off that balance transfer in time, your interest is going to skyrocket. Instead of of 7%, it could be like 30%. So as I mentioned before, if you have federal student loans and you do want to consolidate to lower your interest rate, do a direct consolidation loan so that they're still federal. Most of you are probably okay just to leave your student loans as they are. I know for a lot of people, they're kind of strange right now. Student loan things keep changing. So many people don't have a payment even until like 2028 or whenever it may be. One thing I do suggest though with your student loans, depending on the interest rate, depending on your situation, especially if you are only focused on paying down your student loans right now, I would go in and try to get your minimum payment as low as possible. So usually you have to go in and enter your income and the things that you have to pay for, and then they will give you different options like a graduated repayment plan, a save plan, all of that stuff. I know it's been changing though. So yeah, just go in and see what it says. But even if you have to extend the life of the loan, so instead of paying it down in 10 years, if you extend it to 25 years, I do not want you to take 25 years to pay off your student loan debt. Please do not do that. But if you can lower the payment to like, instead of $500, it's $150 per month. You can make that $150 payment, and then any extra payments, you can choose which loan gets paid off faster, like which principal you are going to tackle. So if you have one student loan debt that is 8% versus the other ones that are at like 4 or 3%, then you can just focus on that one. Or by even temporarily lowering your minimum payment for the student loans, this could free up some cash so that you can pay off your credit card debt faster or your auto loan faster. And then you can heavily tackle your student loan later. If you have medical debt, I do recommend calling and asking for a discount. You can either call and just straight up ask for a discount because you can't afford it or whatever the case may be, or you can see if there's an option for you to pay in full in order to get a discount. If you have other debts, credit card, auto loan, maybe even student loans, I would first focus on those before tackling medical debt. You can usually set up a payment plan with medical debt and have 0% interest. So just call, communicate, and get that set up. And you can just add that to your list of debts, minimum payment, all the things. Also, please always double check your insurance claims and the coverage that you have, because if you go to the doctor, even if it's just like co-pays or something small, and especially if you have a bigger procedure, pay attention to what you are being billed, because I have overpaid for several medical procedures. And because I paid attention to my numbers, I made phone calls and got that money back. They will often refund you without you having to call, but it could be like months later, even over a year later, and you want to have your money as soon as possible. You don't want them to have it. So pay attention, advocate for yourself always, and just double check the numbers. But now you see what I mean by shaping your debt. Hopefully you were able to move things around, get a lower interest rate, maybe get a balance transfer, whatever it may be. And you now can choose a debt payoff plan. And I don't want you to stress about this. You can always change later. You can start with something now and change your mind next month. But I do really, really want you to choose a debt payoff plan, because if you are just throwing extra at all of your debts, you are not going to see progress. It's going to take longer. And if you actually have a plan, that's when you're going to start seeing a difference. First, we're going to go over the debt avalanche method. This is my personal favorite. This is how I chose to tackle my debts. I really like this one because it saves you the most money and it makes the debt payoff faster. So with the debt avalanche, you are going to pay your debts from highest interest to lowest interest. That's the order that you are going to go in. So with this example, the highest interest debt is credit card A. Let's say all of this stayed around. You know, if you moved your debts around, you got something down to a 0% or 9.99 instead of these, then change that in your sheet, change that on your paper. And now you need to factor that in, right? But we're going to pretend these stayed the same. So for these examples, it would be credit card A is your first focus, and then credit card B. Then it would be your car, and then the student loan is last. So for these three, you will pay the minimum payment. And then for this first one with the highest interest, you will pay the minimum payment, but you will also be directing any extra amount to just credit card A until it is paid off. Once it's paid off, that minimum payment, so this $95, at least $95 plus whatever extra debt payments you were making. So let's say you were also making $100 per month of extra debt payments, or it can fluctuate too. But that is now going to be going to credit card B until it is paid off. So this one's done. We're moving on to credit card B. And then same thing. Once this one is paid off, you've freed up $250 plus 95 plus 100 or whatever extra amount. And that's paid off, you're going to move it to the car. And so it's just going to speed up this debt payoff. Or you may prefer the debt snowball option, which is honestly what most people choose because it is very mentally satisfying because you can kind of get a win under your belt pretty quickly. And this is where you are tackling your debts from lowest balance to highest balance. So for this example, honestly, this isn't, it's actually going to be the same thing, isn't it? And that happens pretty often. So credit card A has the smallest balance. Credit card B has the next smallest balance. And then it's your car. And then it's your student loan. Okay. So that works out pretty well. But let's say your car was just like $4,000 left on it. So instead of going, you would pay off credit card A first, and then you would move on to the car, and then you'd move on to credit card B. So you're not looking at the interest rates. You would just be focused on the balance. And same thing with this one. You would be paying the minimum payment due on these 3 debts or however many debts you have. All of your focus would be on credit card A until that's paid off, and then that minimum payment would roll into credit card B's payment. It's the idea of the snowball. So as the snowball's rolling down the hill, it's getting bigger and bigger, and it's going to keep on going down the hill. Another method that isn't talked about too often, I just call it the largest minimum payment method, I suppose. Somebody's given me a term for it before, but I can't remember. So you are now going to be looking at the minimum payment due and sorting by largest to smallest. So for this example, your car would be first because it's a $375, and then credit card B, and then student loan, and then credit card A. You pay the minimum on these 3 debts. Your focus would be on your car until that's paid off. This has the largest payment, so you'd be paying the $375 plus whatever extra amount that you can afford on a monthly basis. Then once your car is paid off, you have freed up a pretty large chunk of cash, and that $375 is going to go toward credit card B. And then once credit card B is paid off, you have this $375 plus $250. These huge amounts will go into the next one. And at that point, things will go pretty quickly. This isn't a method I recommend for most people just because it usually is things like your car or student loan that have a much lower interest rate. And yes, it may feel good to free up this money eventually, but these credit cards are going to cost you a lot of interest during that time because these are a larger balance. It's going to still, even with a larger payment, it's still going to take you a lot of time. And these credit cards are just with the interest, it's going to be growing and growing. And yeah, it just depends on the situation. But if you have just like a car loan and a student loan, that maybe it would make sense for you to do the one with the highest minimum payment because the interest rates are similar. Another method is by urgency. So it wouldn't really be relevant to any of these examples here, but maybe you have a debt that's about to go into collections, or even you could owe your mom money or your sister or somebody in your life money, and it's adding some stress and tension to that relationship. So you're like, I really just want to pay that off so I don't have to worry about that with my family member or friend. Or you don't want the debt to go to collections, or you don't want to have to owe the IRS. So you want to first do that and then choose one of these. So that one's very situational. I've worked with many clients who owe their family members money, but their family doesn't mind. And so they are like, I just pay them if I can, or just $50 per month, and they don't mind. So that means it's not an urgent debt and you can choose one of these other options. So you've shaped your debts, you're looking at your debts, and now you want to choose one of these, and you can go ahead and select that. I would put your debts in that order. On your piece of paper, put that order that you're going to be tackling your debts, or if you're using my spreadsheet, there's a way that you can automatically do this, but I do want you to put it in that order. So let me show you. I've entered these debts into this spreadsheet here, and you will want to highlight all of it. So from the first one and all of them, and you are going to double click or right click, scroll down to view more cell actions, sort range. And then if you select the column, if you want to do debt avalanche, for example, we are going by interest rate. So we want to use column D, and you're going to sort from Z to A because we want the highest to the lowest, and then sort. And so now it is in that order. Credit card A, credit card B, car, student loan, because the interest rate. If you want to do snowball method, highlight again, scroll down, sort range. We're going to go based off of column B because that's where the amounts are. And you want to go from A to Z because it's smallest to largest. So sort. And now it's going to be the same order because, yeah, this is how the numbers are, but you get the idea. You can do the same by minimum payment as well. If you are someone who forgets to make payments, I want you to set up autopay. If you've been paying fees recently because you keep on missing payments, I want that gone. That is an expense that you can completely prevent. So turn on autopay. You should already know your due dates, but make sure in your budget you have those dates in there so you know when those payments are coming up and you have enough in your checking account. If you notice that all your minimum payments are due around the same period, you can request your due date to be changed, but just know that it usually takes a couple of months for those changes to actually occur. But you usually don't even have to call. You can just log into your bank and request a different due date. So now you know which debt you want to pay off and your debt payoff plan, even if it may change in the future. Right now, you've got that figured out. But first, I do want you to give your savings some attention. So we are going to talk about savings, but I do want to go over credit scores briefly because I know credit scores are a big topic. I'm not going to get too nitty-gritty with credit scores just because I don't think there's something that you should really be paying too much attention to throughout your debt payoff journey. Sure, it's an important number, but sometimes people get obsessed and then they are trying to quickly raise their credit score and they choose these sign up for things that promise an increase in your credit score, and it is just not necessary. Increasing your credit score takes time, but just by paying off your debt, you're going to see a significant increase in your score. Chances are you probably don't need a high score right now, and maybe you do want to buy a house and get approved for a mortgage or a different loan. But if your score is low, then you probably should hold off on that home purchase or big purchase anyway until things improve, your financial situation improves. In my opinion, just having your finances in order in general will naturally improve your credit score. First of all, what is a credit score? In simple terms, it's a number to determine how risky you are as a borrower. So lenders use it to decide whether they want to approve you for a loan at all. It helps to determine your interest rate as well as your limit, like your credit limit or loan limit. And then sometimes this can affect housing, insurance, and even job decisions. Most scores range from 300 to 850, and then those are kind of tier ranked. There's poor, fair, good, very good, and then excellent. There's a couple of places where you can get your score for free. That would be your banking apps. Oftentimes they will show you your FICO score. Sometimes it's your Vantage score. You can also use free apps like Experian or Credit Karma, which I prefer to use because they also give you notifications and kind of keep an eye on things. So if anything changes with your score, a new inquiry hits your account, then you should be notified of that with those apps. So that's your credit score. You can also run your full credit report through annualcreditreport.com. I do recommend, I talked about this in the first section, so hopefully you've already done it and made sure everything looks okay and got a full understanding of your credit report. You can pull your credit report for free one time per year through that website, and I do recommend pulling it at least once every year. And so that credit report is your full history, while your credit score is the summary number based on that report. There are also 3 different credit bureaus, and your score may differ between the 3 of them. If you're curious about which bureau lenders use, you can often do a Google search. So which bureau does Chase often look at versus Capital One or a specific loan that you're trying to go after? You may be able to find that information through Google, but it just depends. There's also 2 different types of scores. There's your FICO score and your Vantage score. So I will put up a table of the main differences between the 2. If you're using an app like Credit Karma, that's going to give you your Vantage score. Sometimes bank apps also give you your Vantage score, but usually you'll see a FICO score, and these 2 numbers may be different as well. Usually your Vantage score is a little bit higher than your FICO score, but not guaranteed. It just depends. As far as those 2 numbers go, I would use your Vantage score to kind of stay engaged with your score and monitor your habits, and then check your FICO score before any major financial moves. Because when you're going to apply for a loan or even open a new credit card, it is not the Vantage score that's being looked at, it is your FICO score. As for what makes up your credit score, there's also a little bit of a difference between your FICO and Vantage score. But the most important piece of your credit score, what makes up about 35% of your score, is payment history. So this means you want to make on-time payments, because even one missed payment on your score will affect it for years. It won't be wiped off for like 7, I think it's 7 years, could be 9, but yeah, for years it's going to affect your score, and you don't want to do that. Try to avoid missing payments by all means. The good thing about most debts is there's a pretty large grace period. So yes, you want to make your payments on time and make a habit of that. But if you do miss a credit card payment, for example, it's not going to be reported to the credit bureaus until it's 30 days late or more. And then after 30 days, if you still haven't made a payment, the next time it's going to hit your credit score is after 60 days, after 90 days, etc. And the longer you go, of course, it's going to just tank your score. So try your best to always make payments on time. Next largest chunk of your credit score would be credit utilization. This makes up about 30%. And this is how much of your credit you're using compared to your limits. A lower utilization equals a better score. So if you have a total credit limit of $10,000 and you have a total balance of $8,000, that means you are using 80% of your available credit, and that means your score will probably be lower. You'll see a lot of numbers thrown around with this one. So a lot of apps or like banking apps will say under 30% is okay. 10% would be ideal, but personally, I prefer 0%. My credit utilization is always 0%, and I have a score in the 800s. So it is a myth that you need to always carry a balance. The thing too is that as you get older and you have more of a credit history, you've taken on student loans and credit cards, a car, a mortgage eventually, all of these things are going to be taken into account with your score, and it's going to be easier and easier for you to increase. And so having any sort of utilization is not necessary for you to maintain a high credit score. About 15% is determined by the length of your credit history, so how long you have even had credit. If you are 18 years old, you probably barely have any credit history, maybe none at all if you don't have a credit card or student loans, anything in your name. This is another one where as you get older, it gets a little bit easier to stay in the green zone, in the safe zone with this one, because maybe you opened your first credit card at 18 and then you still have that card at the age of 40, so that's over 2 decades of credit history. And so as long as you're keeping that card open and in good standing, then it's going to help your length of credit history. If you close that card and the most recent card that you opened was when you were the age of 39, then the length of your credit history is going to decrease, and you will potentially see a decrease in your score as well. And this is why you'll often hear people say to not close your credit card after you've paid it off. And that definitely is something to consider if it's one of your oldest cards, like you've had it for 10 plus years or maybe even more than a few years. But if it's a more recent card, or you're like, I don't even want to deal with this anymore, it doesn't give me any benefits, or I just want to minimize how many cards that I have, it is okay to close cards that you've paid off. Yes, it may lower your score, but not by much, and it's just going to be temporary. You will easily be able to have it recover back to where it was within a month or two. About 10% of your credit score is determined by credit mix. Auto loans, credit cards, student loans, mortgage. Another one that is easier as you kind of build your financial situation and as you get older. Please do not take on new debts just to have a mix of credit. This is just 10%. So paying on time and credit utilization, most important. Another 10% of your credit score is made up by new credit or inquiries. So when you go to apply for a loan or apply for a new credit card, those will trigger a hard inquiry. So your credit score is being checked to see if you will get approved for the loan or the credit card, and you will probably see your score temporarily lowered. But again, it is just temporary. After a couple of months, it should recover, no problem. But I wouldn't be applying to loans left and right or new credit cards left and right. Like if you're doing too many at once, that's going to signal a problem, and you probably at that point would lower your score by quite a bit, or just be getting rejected for credit cards and just keep hitting your score. I do want to offer you some tips to increase your credit score, because no matter what, this seems to always still be an important thing to people. But also, if you are trying to do a balance transfer, you want to do some consolidation, one of those things we talked about before, you may want to increase your credit score first before trying those things. So my first tip is to always make payments on time. That's a given. That's a non-negotiable. Set up autopay if you need to. I don't want you to be paying any late fees, and I definitely don't want your score to go down. Lower your credit utilization. Your utilization utilization will naturally lower as you pay off debt. So no matter what, you should be seeing an improvement as far as your credit utilization goes. But if you can make an extra payment on that main debt that you're focusing on, so if you chose the snowball, you're focusing on that first lowest balance debt, you make your minimum payment, right? But then you want to try to make an extra payment before the statement date. So you have your due date. A few days later is the statement date. That's when things are reported to the credit bureaus. So you pay your minimum payment, let's say it's due on the 7th of the month, and then your statement closes on the 11th of the month. So try your best, do whatever you can to make an extra payment before the 11th and lower that balance as much as possible, because that new lower balance is what's going to be reported to the credit bureau, and it will show an improvement in your credit utilization, and you should see an increase in your score. You could also request a credit limit increase. This is usually something you can do online. So log into your account and find somewhere that says request credit limit increase. And then they will ask you a couple of questions, usually in regards to your income and like how much you pay for rent, for example. Sometimes you will be approved for an increase immediately, or sometimes it could take a week and they have to look into things and then they will let you know. They may not offer you an increase whatsoever, and that's fine. This isn't going to affect your score or anything. I really wouldn't apply for this unless you've seen an increase recently in your income or like a decrease in your main expenses. Also, an important thing to call out here is just because you increase your available credit, it does not mean you should go and spend that money. So as I've mentioned several times in this section, if you feel that you cannot responsibly use more freed up credit, then I would not do this. So that increase is meant for you just to get an increase in your score, not for you to go spend more money. Keep your old accounts open if you want to. If there's a card that you're like, I hate this card, it gives me bad vibes. After I pay off my credit cards, I only want one of them, whatever it is, then you can close it if you want to. But if it's one of your oldest cards and you're like, hey, I want my score to kind of stay where it's at or increase, then keep it open. You don't need to use it often. Just charge something small to it every 6 months to a year. Several cards will actually send you a notice before closing a card, and they'll say, hey, you haven't used it. If you don't use it within 60 days, we're going to close your account. So sometimes they give a warning, sometimes they don't though. So that's why I recommend just charging a little bit to it every 6 months. Go to the gas station and put $5 in your tank, or grab a bottle of water or something like that. And then just make sure you pay off that purchase. Don't forget about it, because then you're going to have a late payment, and that's going to change a lot of things. But yes, keeping an old account open helps with that credit history. So you may want to keep it open. It's up to you. And then just be strategic with new credit. Obviously, there are times where it's like, okay, I want to get a mortgage, so I'm going to apply for a home loan, or I'm going to get a car. So that's what's going to be happening. So the main thing here is only apply when you actually need to. I also recommend only applying for credit when you feel financially stable and you understand the impact of this new credit. If you're somebody who eventually wants to use credit cards to take advantage of points and rewards, travel rewards, whatever it may be, then, you can do that. At one point, I was not a responsible credit card user, and now I have 12 credit cards and I never pay interest on them, but I get a whole bunch in points. This isn't for everybody, but it does work for some people once you get to a point of having strong financial habits. And if you get to this point, just make sure you are spacing your applications out. I like to use this free website called Cash Freely. You enter in all of the credit cards that you have and like when you applied for them, the bonuses. So it helps you to keep track of bonuses you need to hit and which cards to use for which points. And then it also recommends the best time for you to apply to a new credit card. So if it's been a good amount of time since your last application, there is a section on there that will say, hey, you're probably good to apply for a new credit card and you are more likely to be approved for that. So I think it's a really handy tool to have. It's free to use. I'll have that link down below as well. And then I do recommend checking for pre-approvals first. We've kind of already talked about this with the consolidation, the balance transfers, but there are websites that you can see if you're pre-approved by entering in some information, or maybe you get offers in the mail or through your email, and you are more likely to be approved for pre-approval offers, but it is never guaranteed. We've already talked about this, but I'm going to say it again. Check your credit report for any errors. If you see something that is wrong on your report, then dispute it. I've worked with a client before who had an eviction on his report, even though he had never been evicted. He had a very common name, so there was, I don't know how it happened exactly. You know, there's technical errors, human error that goes into things, and you never know. Your identity could have been stolen, or something could have gone into collections mistakenly. So always advocate for yourself, and if something's been paid off and they're not marking it as paid, then dispute it, get down to the bottom of it, because yeah, of course, nobody's going to care more than you will. And if you are trying to rebuild your credit, so you have lots of debt in collections, or you don't have a credit score whatsoever, focus on consistency, not on speed. Increasing your credit score is not something that's going to happen overnight, but the time is passing anyway. Like, I promise your score will go up if you just go through everything in this video and actually put it into action. If you're paying off debt, if you are making payments on time, you are being consistent with your financial habits, your score will increase. If your credit score is really low, or you've recently filed bankruptcy, for example, you may want to consider a credit building loan. One of the best websites for this would be Self. I will have this link down below as well. Through Self though, I do not recommend a secured credit card because it has a fee after the first year, I believe, but their credit building loan is awesome. So with a credit building loan, you choose an amount that you're comfortable with. When you go through the process, you will see what your minimum payment would be on a monthly basis. And so as long as you're confident that you can make that happen, it'll be something like $20 every month for 1 year or for 2 years. And what's cool about this is, yes, there's a fee associated with it, but at the end of it, that money is yours. So this is kind of like a little savings hack too. So as long as you're making your payments on time, your score will increase. And then after that time period, whatever it is that you selected, you will have that to use. It will be your money. You could also apply for a secured credit card, and this is where you're putting like $250 or $500 of your own money onto this card, and then you make purchases with that card. You're going to have a minimum payment. You're going to have a due date, the same thing. It's your money that's on that card, so you're just having to pay yourself back basically, and that's the amount that is available, your available credit on there. But those payments are being reported to the credit bureaus, and you will slowly see your score increase. In my opinion, Capital One and Discover have the best secured credit cards, which now Capital One owns Discover, so they go hand in hand. But yes, there's a couple of options for everybody, and just be patient with your score. It will go up. Just give it time. Don't try to do any quick fixes. You will see that change eventually. So the next question is, should I start tackling my debt, making extra payments toward my debt, or should I be saving? Should I build up an emergency fund? Should I have sinking funds? We are going to cover all of that. If you have debt, I know you're probably eager to pay it down as quickly as possible, and you want to start making progress on that. But I do recommend first prioritizing your savings. I want you to avoid going into further debt at all costs, because if anything comes up throughout your debt-free journey, you're going to have cash to fall back on, and it's going to make a huge difference in this journey. So first, we're going to talk about your emergency fund. And the big question is, how much should I have in my emergency fund? And unfortunately, there's no straightforward answer, because it depends on your situation and what you're comfortable with. If you live with family, you don't have children, you don't have pets, your job is pretty stable, then you can probably get away with a few $100 to start with, but I suggest at least $1,000 for those situations. But for most people, I usually recommend about 1 month of expenses, and this would also increase depending on your situation. So some things to consider would be if you own a home, if you have children, if you have pets, if you have an older car, if your job doesn't feel very stable. But for the most part, and as I mentioned before, most people will be okay starting with about 1 month of expenses. To put a number on it, and based off of the dozens of people that I worked with, about $3,000 seems to be the sweet spot. But if you are someone who has the home, has the children, has the pets, has medical issues, then you may want to get to that savings first, prioritize that starter emergency fund first, and then you can move to tackling your debts, but you can also continue saving on a monthly basis, just reduce the amount that you're saving. And then aside from your emergency fund, there are sinking funds, and sinking funds are basically just savings accounts for specific things in your life. Common sinking funds are travel, gifts, home maintenance, children, pets, etc. And honestly, you probably shouldn't prioritize too many of these right now, but if there's absolutely something coming up in the next few months or within the next year, you may want to consider starting a sinking fund or a few sinking funds. Again, the idea here is I don't want you to go into further debt. I do want you to enjoy your life. And if you have some travel plans in the next year, what I want from you is you not to put that onto a credit card, not have to take on debt in order to enjoy that travel. So instead, I want you to save up for that travel, and then there won't be any debt. And you can do both at the same time. So for most people, especially those on their debt-free journey, the first sinking funds that they create are travel, gifts, and car maintenance. So what I want you to do is refer back to that year at a glance from the beginning of this course and look at anything that is on your little calendar layout. And if it's something you've struggled with preparing for before, or you're like, I don't have the funds for that right now, then that is a sinking fund that I want you to create. So if you want to spend $1,000 on gifts for Christmas, then you need to start saving for that right now. And maybe you need to set aside $200 per month until November or December. And keep in mind that your emergency fund is separate from sinking funds. That emergency fund is reserved for true emergencies. Not for a concert you want to go to, not for a big sale at your favorite store, not for travel. I want you to try to hold on to that for true emergencies, and then the sinking funds are for you to spend on the specific things that you're saving for. By the way, how you choose to save for your sinking funds is up to you. There are some that you may want to add to on a monthly basis. For example, if you create a car maintenance sinking fund, maybe you're adding $50 to that on a monthly basis, and there's not really an end goal. There's not a number that you have in mind for that. It's just that you're saving for car maintenance, and when something comes up, you have that money to pull from, versus something like travel, and you know that you have travel in July of 2027 or whenever it may be. And you're like, okay, by then I want to have $3,000. So I need to set aside X amount by that point. Or you could even do a lump sum. You're like, hey, I got an extra 1,000. I have a 3 paycheck month. So I'm going to put a big chunk toward that travel sinking fund and then do smaller increments until the time comes. So it's up to you how you do it. And a common question as well is, where do I keep my savings? And I do not recommend keeping your savings in your regular checking account, especially if your checking account is with the bigger banks like Chase or Bank of America or Wells Fargo, because your checking account is one thing. That's where you spend your money from, but your savings is probably going to sit there for some time, and I want your money to be working for you. So this is where a high yield savings account comes in. And typically these are held with an online bank, which is how they're able to offer us an APY. So we would be gaining interest on our money instead of like with Chase or Bank of America, your money is gaining either nothing or maybe like 0.01% interest, versus with a high yield savings account right now, it's about like 3.5%, 4%. It just depends on who you decide to bank with. And so by keeping money in that account, it will be gaining interest that you get paid out monthly. That interest is completely passive. This money is not invested. There's no risk with it, especially if you go with a bank that is FDIC insured. You could take that interest out if you wanted to and put it towards your debt, but most people just keep it in their savings and then that interest compounds. So now you have more in your savings and then you will gain even more interest the following month, so on and so forth. Personally, I have a few different high yield savings accounts. You do not need multiple. You can just have one of them. I really like Marcus by Goldman Sachs. That's the one I've had for the longest. I also like Wealthfront, and I also use Crew. Crew is actually a checking account that earns interest, and then it allows you to create pockets to have little sinking funds in there. For all three of those, I have a link where you can get an extra percentage for about 3 months or so. So those will be linked down below. However, I also think Ally, SoFi, Synchrony Bank, and Capital One are great options, but I do not use them. So I will have those linked down below as well, and you can choose based on what you're looking for. For all of these, you are able to create little sinking funds within it. So you have one account, and then you can have your emergency fund with a balance. You can have your car maintenance fund with a separate balance. You're able to name them, and you can keep track of the balances within that app itself, which I really like, versus traditional Traditional banks or other options that only allow for one savings account, and then you would have to manually keep track of how much is reserved for travel, car maintenance, etc. So they all use different names. Crew uses Pockets. With Marcus, it's just called accounts. With SoFi, they use vaults. With Ally, they use buckets, but they're all the same idea, and all of them will be gaining interest. So whatever amount that you have total in your account, you will be gaining interest on. So all the options I just listed are FDIC insured. They don't have fees. They don't have minimum balance requirements. And again, the ability to create those sinking funds or buckets, whatever you want to call them. Now, I know some people prefer to also have cash savings or cash on hand, like literally cash in your vault or cash under your mattress, whatever it may be. Personally, I never, very, very rarely use cash. So I don't ever have it on my person. So it's not something that I do. I prefer for my money to be in my high yield savings account, my checking account, or invested, but do what works best for you. If you prefer to have cash, you're paying in cash for a lot of things, or you just want some as a savings as well, then you can do that. That is absolutely okay. And that balance is something you can keep track of manually on a spreadsheet or in your notebook, whatever it may be. And now, if possible, I do suggest automating some transfers, some savings transfers, if you can, even if it's just $5 per paycheck or something small. You'd be surprised how quickly that can add up, and it's a great habit to get into. You can do manual transfers for now, but be sure that you fit this into your budget. So I want you to come back to that budget that you created, and you've adjusted your debts at this point. If you have different minimum payments that need to be entered in, or you did a balance transfer, so now there's a credit card that took place of a different credit card, and now you have an idea of whether you need to prioritize your emergency fund or sinking funds. So I want you to fit that into your budget. You can put emergency fund, you can put your specific sinking funds on there, and for the month that you are budgeting for, put in specific numbers that will fit. If you have like $300 left over to budget, maybe you're going to put $200 to your emergency fund and then $100 to your travel sinking fund because you have some travel coming up. And that might mean that you're not making any extra debt payments right now, but that is fine. I want you to prepare for that travel. I want you to have your emergency fund so that you don't go into further debt. If something comes up, you will get to extra debt payments in a couple of months from now, a few months from now. It's going to take time. Be patient, but I would rather you be more prepared for things and have that savings built first. Once you hit your starter emergency fund goal, let's say it's $3,000, you can stop saving if you want to and just let it chill at 3K. If you have to dip into that emergency fund, I do suggest building it back up. So you may have to pause extra debt payments, but at that point you could stop saving. Or if you wanted to, instead of doing like $500 per month to your emergency fund, you could decrease and go to $100 per month and keep on adding to that. It just depends on what you're comfortable with, because maybe you hit that 3K and you're like, oh, I feel so good. Now I want to throw everything extra to my debt. Or you may get to that 3K and be like, this still doesn't feel like enough. I do want to tackle my debt, but I still want to build up my savings, and that's completely fine. Same goes with the sinking funds. If you've hit a goal for a sinking fund, you have enough money saved for that travel or for the gifts that you plan on spending, then you can stop adding to them, or you can just keep on adding and make sure you build up a sufficient amount for car maintenance or whatever it may be. But for most of you, once that starter emergency fund is established and you've taken care of those sinking funds, things are kind of on repeat, most of your extra money or leftover money should be going toward your debt payoff plan. Now let's move on to investing, another big topic. There's obviously so much that I could cover when it comes to investing, so I'm going to try to keep this brief and just touch the main points, but this still will be a pretty big section. I first want to mention compounding growth because this is probably something you've heard before, and many times people don't understand it. And it's kind of the same idea of debt and interest, but in the opposite direction. In simple terms, it's when your money starts earning money, and then that earned money earns more money as well. So your investments can grow from your contributions plus growth on top of that. And that's why we call it compounding, because it just gets added on and added on. For example, and I'm just going to use easy numbers so we can keep things simple. Let's say you have $10,000 invested, and that money is invested in a fund that gives you about a 10% growth rate. Well, your $10,000 will turn into $11,000 because of that 10% growth rate. And now you have a total of 11,000. And so if you continue to gain about 10% from that investment, it's now on that 11,000 total. And after another year, that 11,000 would turn into 12,100. And then same thing for the following year. You are going to see growth on that full 12,100. And from this example, you started with 10K. You didn't add anything else. That was just compounding growth. This is also exactly why you've probably heard time in the market is so important, and people encourage you to invest as early as possible, because the more time that your money is in the market, the more opportunity it has to grow, the more opportunity it has to compound. And at first, things are going to go slow. This is also why you always hear it's so hard to get to your first 100K invested, because a lot of that money is you actually making contributions. Yes, your money's going to grow from compound growth. Going back to that example of the 10K, after a year at a 10% return, you grow by $1,000 versus if you had $100,000, your money would grow by $10,000. And then if it was $1 million invested, you would see growth of $100,000. So don't let those early figures discourage you. Don't let small amounts discourage you. Being more consistent is ideal than any sort of timing of the market. You don't need to wait for a dip in the market. You don't need to wait for having a certain amount of money. I want you to invest early and often, but let's talk about what to invest in, because that also depends on your situation. So we're going to start with employer-sponsored plans. And now not everybody has access to this, but you should know now from the first section of this course, your employer benefits, if you get a match, the vesting schedule for your plan. And you may have access to either a 401k, a 403b, a 457b, or a TSP. It just depends where you work, the industry you work in. All of these are very, very similar. There's some small differences between these, but I'm not going to get into the details of that because for the most part, they behave the same. The max amount that you can contribute for 2026 is $24,500. This is a number that usually increases annually, sometimes every couple of years. It just depends on the economy. However, if you are over the age of 50, for 2026, you can contribute a total of $32,500. So there's a catch-up contribution, and every year after the age of 50, there's that catch-up contribution would apply to you. If your employer offers a match, I typically do always encourage people to take advantage of that because it's part of your pay. It's free money, basically. But there are some exceptions, which we will get to. But to give you an example, let's say that your income is $50,000 and your company offers a 6% match. So you would contribute $3,000 in the full year if you took advantage of that 6%. And then your employer would also contribute $3,000 for a total of $6K in the year. So doubled your contribution. Depending on where you work, sometimes this might look a little bit different. It could be 100% of the first 6%, or it could be 100% of the first 4%, and then 50% of the next 2%. So that's basically like 5, or it may be some similar number to that. It could be much lower than this, or your company may not match at all. If your employer does offer a plan, they definitely have a traditional plan option, but it's becoming more and more common for a Roth option as well. Now, this is not a Roth IRA. A Roth IRA is completely different from an employer-sponsored plan. We are going to talk about that in a bit. That is something you open and fund on your own. This Roth 401k or Roth 403b, whatever it is that you have, it's just an option, a style of investing. You've probably also heard pre-tax versus after-tax. So traditional is pre-tax dollars, and then Roth is after-tax dollars. And so what this means is when you contribute to traditional, this will lower your tax burden right now. But if you contribute to Roth, this will not lower your tax burden right now, but it will grow tax-free. And then when you withdraw from this account in the future, after retirement, you would not pay taxes for the Roth 401k or whatever it is. Versus with the traditional, you would be paying taxes later. In retirement, on those withdrawals, you'd be paying taxes, but it lowers your tax burden now. If your employer does offer a Roth option, you should also be able to do both. So if you had the 6% that you were contributing, you could do 3% to traditional, 3% to Roth, or 4% traditional, 2% to Roth. Keep in mind that oftentimes the employer match is traditional, but it just depends because more recently things have been changing and you can elect for the company match to be going to your Roth option, but it just depends on where you work. I think as years pass, that's going to become more and more common, where more employers would offer that. But yeah, for the most part, that employer match is going to traditional. It does not lower your tax burden any further though. It's just what you can contribute that is what's lowering your tax burden. One other important thing to call out, especially if you're somebody who's like a high income earner, or you're like, I don't have that much in expenses, I want to max out my 401k or whichever plan. Your employer match does not go toward, it doesn't count toward the max amount in the year. So if you can contribute $24,500, let's say you have an income of $100,000 gross, you put in $24,500, your company matches 6%, so they would be contributing $6K, and that gets tacked onto this. So a total of $30,500 would be going to your 401k that year. So the company match does not count as part of the max contribution for the year. Same goes if you're over the age of 50. Now you may be thinking, okay, which one? I have both. I have the option to contribute to both of them. Which one should I choose? How much should I do to traditional? How much to Roth? It's completely up to you, and you want to think about your current income. If you're a high income earner, maybe you want to do more to traditional so you can lower your taxes now. Or maybe you're like, I think I'm going to have more money in retirement, or I don't know what taxes are going to look like, so I just want to do all Roth right now. It's up to you. Personally, I like the approach of all traditional for my 401k, and then I aim to max out my Roth IRA. Again, that's a separate account. You open and fund that on your own. I'm going to talk about that in just a moment, but that's the approach I like to take. So I have a balance between traditional and Roth IRA, or pre-tax and after-tax. And for most people that I talk to, clients that I worked with, I do think that they should contribute to their employer-sponsored plan at least up to the match, but there are a few exceptions. So first one would be if you are living paycheck to paycheck or worse, like you're about to be evicted, or you can't pay your bills, anything like that. That is way more important. I want you to have a solid foundation before even thinking about investing. Get that straight, and then you can come back to this. A second thing would be if your employer doesn't offer a match whatsoever, you may want to invest elsewhere, and I will talk about other options. Third thing would be if your employer has a ridiculous vesting schedule. So I have already explained what this was at the beginning, but just to remind you, your vesting schedule determines if you would get to keep the money that your employer contributes to your plan. So if they have a 5-year vesting schedule and you leave the company after 3 years, whatever amount that the employer contributed, you wouldn't get to keep that. Anything you put in is always yours, right? It's invested though. But anything that the employer contributed for the 3 years that you were there, that would not be yours to keep. If you stayed for 5 years and then left after 5 years or after 6 years, you would be able to keep it. So that's how a vesting schedule works. I really, really dislike when companies do this, and it's not too common, but sometimes there's different variations of it. These days, more and more companies are having company matches be vested immediately, which is ideal. So even if you've only worked at the company for 3 months or 6 months or 1 year, no matter what time you left, the company match is still your money to keep. It would stay invested in your account. So obviously that's up to you to decide. If your company does have one of those ridiculous vesting schedules, then you want to give it some thought, like, will I be here for 5 years? Will I be here for 3 years? Whatever it may be. And then you can make that decision. But for most people, I do recommend contributing at least up to the match. And this is even if you have debt that you're working to pay off. By the way, I am going to give you some ideas of what to look for when it comes to how to actually invest your money. But I first want to go over a couple of different other account options. IRA. So there's also a traditional IRA and a Roth IRA. IRA stands for Individual Retirement Account. Again, this is not something that your employer offers. This is something you open and fund on your own. And same thing goes with taxes for traditional IRA versus Roth IRA. As I explained before, traditional lowers your tax burden now. You would pay taxes later in retirement. Roth IRA does not lower taxes now, but you would not pay taxes later on withdrawals. Now, there are some IRAs are a little bit weird. So when you contribute to a traditional IRA, there are some income limits that would make this not tax deductible. It also depends on if your employer offers a plan and things of that sort. So if you choose to do traditional, then that's something you'll want to look into more, especially if you're a high income earner for the both of these, because there are income limitations. For example, for 2026, if you make as an individual over $153,000, you can't contribute to a Roth IRA, or it starts phasing you out. So if you're a high income earner or you're just not sure, you will want to look into the income limits. Now for 2026, there is also a max amount that you can contribute to your Roth IRA. Every year there's a max amount, but this is another one that usually changes annually. Sometimes it increases every couple of years instead, but $7,500 is the max for 2026. This also has a contribution limit. If you are over the age of 50, you can do an extra $1,100, so $8,600 total. Now you could contribute to both of these. If you want a traditional IRA and a Roth IRA, you can do that, but this is the max amount total that you can do. So if you wanted to do half to traditional, half to Roth IRA, you can do that. Or if you want to do all to Roth IRA, you can do that. All to traditional, you can do that. It just can't go over this total. There's also more flexibility with the timing of contributions to your Roth or traditional IRA. So you can contribute for 2026, if you're doing your Roth IRA, for example, you can contribute from January 1st, 2026 until April, till tax day, which I believe is the 15th of 2027. Sometimes it's the 18th, depending on the weekend, but that's how long you have to max out your 2026 Roth IRA. Then it would start over in 2027 on Jan 1. And then through April 15th, 2028 is when you could contribute to your 2027 Roth IRA. So there is about that 4-month period of an overlap, and you can contribute to both. So if you're not able to finish it within the calendar year, that can go until tax day of the following year. You could also do the full $7,500, or if you're over 50, $8,600 on Jan 1 if you had it. You have $7,500, you're like, I just want to max it out. I'm going to do it on the 1st of 2026 or 2027. You can do that. Or you could divide this by 12, which is $625. And that's how much you would need to contribute per month in order to max it out by December. So January through December, if you do $625, then you would max out your IRA. Or you can do whatever you can. So in January, maybe you do 1,000, and then February, you only do 200. April, you do another 1,000. You get the idea. You can choose how you want to invest it, but just up to the max contribution. As I mentioned when I was talking about 401ks, my approach is I contribute to my traditional 401k, and then I aim to max out my Roth IRA on an annual basis. I do not have a traditional IRA. It is all just Roth. That is just a personal decision. Doesn't mean that's what you need to do. I like the balance between my traditional 401k and my Roth IRA, and that's how I've been doing things for years now. It's up to you and your situation. Again, if you're a high income earner and you make over that 153K limit, limitations come into play if you're a married couple as well. If you're a low income earner, but your spouse makes like 300K in the year, you would want to look more closely at the income limits, because you probably would need to do a backdoor Roth IRA, which is a legal option. You can do that. I'm not going to get into the specifics here, but if you're a high income earner, look into backdoor Roth IRA if that's something you want to do. Also, if you are married and filing separately, you can't contribute to a Roth IRA. So keep that in mind. If you live together, married, filing separately, you cannot contribute to a Roth IRA. But if you're married and filing taxes jointly, you can contribute to a Roth IRA. There's weird rules with IRAs. Unfortunately, it gets a little bit confusing, but for most people, you shouldn't have any problem contributing to either or of these. Just read more details. I'll have it in my description box. Now we're going to talk about HSAs, which these are one of the coolest accounts in my opinion, because they are triple tax advantage, meaning when you contribute to your HSA. That lowers your tax burden now. The money in your HSA grows tax-free. And then when you use the money for qualified medical purchases, or when you're older, you can use it for other things, but we'll talk about that. But when you use it for qualified medical purchases, that money does not get taxed. So it's an amazing account to take advantage of if you have access to it. Not everybody does. So HSA, first of all, is health savings account, and you would need to have a qualifying high deductible health plan. So you may have it available through your employer or even just through the marketplace. And usually this means your deductible is much, much higher. So instead of like $500 for the whole year or $1,000, it's like $8,000 or $12,000, $6,000, just depends. And it would need to be a qualifying high deductible health plan, because sometimes you may have a high deductible, but it is not qualified for an HSA. Some employers also offer a match for HSA contributions, or they'll even put money in without you contributing anything. Also, if you have access to one, it doesn't necessarily mean you need to contribute to it, but the max amount that you can do in the year is not too high. So a lot of people do like to take advantage of it just because it is so awesome and can be used if needed. So for 2026, as an individual, you can contribute a max of $4,400 in the year. Or as a family, if you're on a family plan, you can contribute $8,750 for the year. Similar to the other ones, but a little bit different. If you are over the age of 55, you can contribute an additional $1,000 plus $1,000. These max amounts also usually change every year or a couple of years, just depending on the economy. With an HSA, you could use that money on qualified medical purchases whenever you wanted to. So if you put in $4,400 in 2026, you have the option to use the money in 2026 or 2027, whatever it may be, or you can invest the money and save it for retirement. By the way, qualified medical expenses would be like copays, surgeries, certain medications. There are even some like supplements that you can buy. Often if you're like shopping on Amazon or even at the store, it will say like HSA eligible for the product. And that means you could purchase it with your HSA card, but you don't have to spend the money if you don't want to. You can, like I said, make this a part of your retirement strategy, which in my opinion is like a huge hack, because what you can do is, let's say you go to the doctor in 2026, or you have a procedure in 2026. It costs you $2,000, right? Well, you're going to keep a copy of that receipt. Do whatever you need to do. Put it in your Google Drive, in your email. You're going to hold on to that information. You're not going to use your HSA. You're not going to pay for that medical bill using your HSA. You're going to wait 30 years from now, 40 years from now, when you're retired, and you can then be reimbursed for that $2,000. And so you've let your HSA money sit in the account, grow, compound, because you've invested it, and then you can still reimburse yourself from that surgery procedure back in 2026 when you're like 60 something. I know that might sound confusing. Hopefully it makes sense, but that is how I would recommend taking advantage of an HSA. But if you absolutely need the funds right now, please use it for medical expenses. But what that means is that the money in your HSA can be invested, and it will grow a lot faster, and, let compound growth do the job. Many platforms, especially if it's through an employer, requires you to have a minimum amount not invested. So like $1,000 cannot be, it needs to be $1,000 cash. It has to stay that way. But then the rest of it can be invested. So invest the rest. Again, we will talk about how to choose what to invest in just a bit, but that's the gist of an HSA. Again, you can reimburse yourself in the future for qualified medical expenses. As long as your HSA was established before the medical bill that you were trying to cover, then that should be no problem. Also, after the age of 65, you can actually use your HSA for anything, but you would pay taxes on it. So if you wanted to buy a laptop with your HSA, you could do that after the age of 65, but you would pay taxes on it. I should mention that there are also FSAs, so a flexible spending account, and those are kind of similar to an HSA, but when you contribute money to an FSA, sure, you may lower your tax burden right now, but you would need to use the money in your FSA within the year. And so for most people, I don't think it's ideal to do that unless it's like, I absolutely know I have these medical expenses coming up, or I want to use this to buy my supplements, things of that sort. sort. But that's the difference there. You would have to use up all of your FSA or else you would lose the funds. So don't let that happen. Final type of account that we will talk through is a taxable brokerage account. This is another account that you would open and fund on your own, and you can invest in whatever you want to, index funds, ETFs, real estate. Yeah, you get the idea. Stocks, whatever you want to. What's unique about a brokerage account is there is no max amount. So if you wanted to invest $100,000 to a brokerage account in a year, you can do that. There are no tax benefits with a brokerage account. So when you contribute, it's not going to lower your tax burden, anything like that. You can also contribute at any point that you want to. So whether it's January or April, it doesn't matter. There's no time frame that you need to be contributing because there's no max. There's also no income limit. So if you're making $500,000 a year, you can put in as much as you want to. You also can withdraw money at any time without penalty. But just keep in mind that you may owe taxes on any money that you've gained in this account. For these accounts, you also pay taxes on capital gains and dividends on an annual basis. So you would typically get a document for this that you report as income when you're filing your taxes. That's why it's called a taxable brokerage account. As you can see, way less rules with this one and lots of flexibility with it. So now the question is, should you be contributing to a brokerage account? Per usual, I don't have a straightforward answer for this because it depends on your goals. If you want to retire early, for example, and you want to have some funds that are easier to access, maybe you're able to max out your Roth IRA and your 401k, or you just want a different option outside of those and you choose to invest in a brokerage account. For most people, it's an account that they open later. So maybe after you've paid off all of your high interest debt, at least, maybe in a couple of years after your income has started increasing and you have more money to invest and you're able to put more to retirement. So you want to do a brokerage. But yes, those are the main accounts. So now I want to talk about where to invest and kind of give you an idea of what to invest in, what to look for. If you have an employer sponsored plan or an HSA, then you will be investing through that platform. So you don't have control of that. It could be Fidelity. It could be some random account that you've never heard of before. So for those, it just depends. But when it comes to your Roth IRA or traditional IRA and your brokerage account, you get to choose where to open that. And so you need a broker. Personally, I'm a big fan of Fidelity as well as Vanguard. So that is where I choose to have my accounts. I have my brokerage account and my Roth IRA with Vanguard, and then I have my HSA and my solo 401k with Fidelity. There are other platforms out there for you to choose from. So if you don't want to go with Fidelity or Vanguard, then you can search around. There's Charles Schwab, there's Robinhood, these other things that you can try out and see what works best. Honestly though, for most beginners and even non-beginners, like people who are very established, one of the best ones would be Fidelity. I think it is a great platform. Pretty simple, has a clean interface, all the things. So that's what I usually recommend. But again, I'm a huge fan of Vanguard as well. And the broker that you use is one thing. But when you contribute to your Roth IRA or you invest in your brokerage account, that is one thing. So you contribute to your Roth IRA, that counts as a contribution. You're going to see it as progress and a progress bar. You've contributed $500 to your Roth IRA. But that does not mean your money is invested. When you put money into these accounts, it also needs to be invested. Same goes with your 401k. If it's not, usually when you first start a job and you have access to a 401k or an employer sponsored plan, you're going to have to fill out some sort of questionnaire or select what it is that you want to be invested in. If this was something you did a while ago, you may not even remember doing that, but chances are if you log into your account, you should be seeing what your investments are, your portfolio. Same thing goes with the accounts that you open on your own. The money's in there, but you need to invest it. And you don't want to make this mistake of your money not being invested because you can potentially lose out on thousands of dollars if you keep it uninvested for a long period of time. And so now the question is, what do I invest in? I do want to put a disclaimer here that I am not a financial advisor, but I myself invest, of course. So I'm going to share with you what I invest in and also what to keep an eye on. Kind of just give you the basics and the common funds that people are investing in. Also, sometimes people ask, should I have a financial advisor or a robo-advisor, somebody doing this for me? My thought is Probably not. You can 100% do this on your own. You are listening to this, of course, but do your own research, okay? Because that's always important. No matter who you're taking advice from, do your own research, decide what it is what you want to invest in, and then you invest your money. If you hand it over to a financial advisor, you are probably paying a monthly fee, but then they are probably getting a percentage of your investments as well. And that's coming out of your investments. You may not see it directly because you wouldn't be in there day to day, but once your money starts growing, that can be a whole lot of money year over year. And it is something that you can manage on your own. And by the way, I'm not a fan of get rich quick schemes or even crypto, day trading, options trading. Those things are legit. They are legit, but that's not the route that I take. I am a long-term investor, so I am just contributing to my accounts consistently on a monthly basis. And I have quite a bit of time on my side. So I'm in my early 30s, and by me starting in my mid 20s, that means I have a lot of time in the market. My money's going to work for me, decades of growth. And so I'm not concerned about trying to make 100K tomorrow, you know? And if that's something that you want, then you're not going to get it here. You're not going to get the information here. And also just know that that's way riskier, of course, because if you drop like 50K in a Bitcoin, it could go down to, it could go way down by tomorrow. That is just a very volatile market. And I like to invest in index funds and ETFs. So in my Vanguard account, which again, I have my Roth IRA and my brokerage account, I own VTSAX. I also own VTI, which is the ETF equivalent of VTSAX, which honestly is probably better at this point because VTSAX has a minimum investment requirement. When you're first getting started, you have to put in, I think it's $3,000. And then after that, you could just do like fractional purchases. But VTI does not have that. And they are basically the same thing. So VTI is just fine. Both of those funds are the total stock market. I also own VXUS, which is an international index fund, as well as VGT, which is Vanguard's Information Technology Fund. This one has a little bit more risk to it, but more growth. In my Fidelity accounts, I hold FXAIX, which is the S&P 500, FSPGX, which is a large cap growth index fund, FSELX, which is a semiconductor index fund. And I also own VGT in this account. So that is a Vanguard ETF through Fidelity. Again, Vanguard Information Technology Fund. All of those are index funds or ETFs. The main difference between an index fund and an ETF is when the purchase occurs. So when you buy an index fund, let's say it costs at 9 a.m. in the morning. We're going to simplify it. It costs $100 for one share of whatever it is that you're purchasing. When you go in and make a purchase for that index fund, you probably won't be paying that $100. It's going to be whatever the cost is at the close of the market. So maybe at the end of the day, so 4 p.m. Eastern time, the market is closed. Instead of $100, it closed at $98. So that is how much it costs you. It's just the trading time versus an ETF. If you go in at 9 a.m. and make a purchase and it costs $100, that is what you would be paying. You'd be paying $100. There's often differences in the expense ratio and just like the smaller details of the funds, but that is the main difference between them. So as of right now, at the age of 32, I only own index funds and ETFs, which means I'm invested in 100% stocks. I do not have any bonds. I like to be more risky because I'm young, I have time. I don't really want any of those safer options, but I'm not too risky where it's like I have all Bitcoin or I do day trading, anything of that sort. It's just index funds, ETFs, and then bonds. I probably won't buy any bonds until I'm in my mid 50s. So if I still have this YouTube channel around, I will keep you posted. And again, that is what I do. Doesn't mean that's what you need to do. If you don't feel comfortable with owning 100% stocks, you do not need to do that. What I do want to break down right now is how to read an index fund summary sheet because you can get some good information from there. And it kind of can give you an idea of what to look for when you are investing your own money, whether that's in your Roth IRA or with your employer. Oftentimes with an employer sponsored plan, they will create a portfolio for you. So depending on your risk tolerance, after you fill in a questionnaire, they will just put you into some amount of stock, some amount of bonds. But for most of you, you can also customize what it is that you're invested in. And that's the approach that I preferred to take when I was working a 9-to-5. And so let me show you what you would look for. So I'm on the summary sheet of VTSAX. This is directly through Vanguard's website. And really the main thing you see here too, that this is also available as an ETF, and that would be VTI. So this is just VTSAX. You can see that there's an investment minimum of 3,000 like I was talking about. So if you're seeing that, that's one thing. That's usually not something that you'll see on Fidelity, which is why I think it's a great option. But yeah, that's one thing. So in order for you to make your first purchase of VTSAX, you would need $3,000 to start. After that, you could do like 100, 200, whatever you can afford. Numbers I like to pay attention to though would be the expense ratio. I prefer this to be lower. If it's like 0.1 something, that costs you quite a bit in the year. So this is just the cost to own the fund in the year. It's very normal to see something under 0.1%, and that I like it to be lower. If we hop over to the ETF equivalent, which is VTI, you'll see it's even lower. So 0.03. If we scroll down on this page, you're going to see some performance summary, just some quick facts on it. So year-to-date returns about 12%. You can get more information here if you want to read about it, the history of it, all of that. There's a risk and reward scale. So when it's higher risk, there's usually more reward associated with it. But also if the market goes down, you're probably going to see a larger dip in your stocks as well, and in your value as well. When it comes to growth, I really like to look at the long-term visual. So for example, if we're looking at just a year, 30%, that's pretty significant. The market is up. It's been up for some time, for a few years now. And over the last year, VTI has seen growth of about 30%. That is a lot. But if we zoom out and look at the last 10 years, or even since inception, since this fund was created, it's been about 10% since inception and about 15% for the last 10 years. Still amazing. That's still amazing. That's what I look for. So low expense ratio and then a higher rate of return across a longer time period. If you continue to scroll down, you can also see what the fund is made up of. So VTI is the total stock market, and same with VTSAX. So there's almost 3,500 different stocks in this fund. So that means if one of the companies goes out, then you are still very highly diversified. And this is the beauty of index funds. So instead of you just owning Tesla or just owning Google, if those were to crash, if Google were to go out of business, you could potentially lose all of your money, right? Versus if you own something like VTI, things are going to balance out. A new company would come in. Same with the S&P 500. That is 500 of the top companies. If one of them were to fall out, another one would take its place and things would balance out. You are going to see fluctuations, but that's the general idea behind it. And then if you keep on going, you can see, so this is the sectors that you're invested in. VTI is primarily technology. That's very common these days. And then you can even see the specific holdings down here. So we've got the top 10 stocks in this fund: NVIDIA, Apple, Microsoft, Amazon, Alphabet, Broadcom. These are all things you've probably heard of. There's also often going to be overlap between this fund and another fund that you may be investing in. Some people get weird about that. It doesn't bother me. So for example, I own VTSAX and VTI, so overlap there, like 100% basically. And then in my Fidelity account, I own FXAIX, which is the S&P 500. There's definitely overlap there, because in an S&P 500 fund, you're going to have the Apple, you're going to have the Tesla, the Alphabet, the Amazon, all of those. It's not something that bothers me. You could just own one of these and leave it at that, but you may also want to dabble into some international funds or some real estate or target date funds. It just depends. We'll talk about that more. I also want to show you Fidelity. So Fidelity summary looks a little bit different, but this is FXAIX. So what I was just talking about, the S&P 500 fund through Fidelity. This one has a little bit less risk if we compare it to VTI, and this is the price of it. We can see the 10-year growth, 15.63%, also very good. Even higher at 1 year, but that's not a number we want to be paying attention to because that's not the full picture. If we go to the summary, you can see the expense ratio, which is 0.015. Very, very low. This is why I love Fidelity, because they even have some 0% expense ratio funds. So like FZROX, those could be a great option for you, but this is very, very affordable. On this page, you can see some hypothetical growth. They have it in a nice graph, but if you keep scrolling down, they're going to break down the top 10 holdings: NVIDIA, Apple, Microsoft, Amazon. You see, basically the same as with VTI. And then you could click into this and see everything. So all the details. Again, this is the top basically 500 stocks. And the S&P 500 is also heavily in the technology sector as of right now. That same information should be available through your employer-sponsored plan as well. The expense ratio, growth across 10-year period or longer, as well as what it's actually invested, what the stocks are actually, what it's made up of. So I gave you the exact funds that I invest in, but if you're looking through your employer, and sometimes there's like crazy names on there that you have never heard of, but there are some key terms that you can look out for and be like, oh, that's probably what I should be zooming in on, and look at the expense ratio, all the details. So if you see anything with the S&P 500 or just 500, anything with total stock market, any sort of international funds may be worth looking into. Small or large cap growth funds are very common too. You may even see some real estate. And then you'll probably see some bonds available if you do want to invest in bonds. There's like total bonds, US bonds, international bonds, treasury bonds. Those are key terms to look for. And then if all of this feels too overwhelming, you could look into target date funds. So it will usually say like target date fund 2055. And so you want to be looking for a year that you would probably be retiring in. So think of your age now and what the year will be when you are 65 or 62, somewhere in your 60s, right? And that's the fund you may want to select. And these can be a great option if you want kind of a hands-off approach without like full-on money management. It is being managed by a team, so there is going to be a little bit higher of an expense ratio. But the way that this works is as you get closer to retirement age, your actual portfolio will adjust. So right now, if you're like in your 30s and you choose a target date fund, you'll probably go into that fund and see a whole bunch of stocks right now. But as the years pass and you get closer to retirement, you will start seeing less stock, more bond, and that will just be happening for you. You don't have to change anything. So I know that was a lot. A couple of things to call out with investing. Money that you need access to within the next few years. I typically don't recommend investing. So if you're like, I want to start saving for a house down payment, or I need to go to school and I think I'm going to invest that money. But if that's going to be like next year or in 2 years, you probably don't want to invest that money. You're better off just putting that in a high yield savings account and using like a brokerage account or any other investments for way in the future, like 10 to 15 years from now. It just depends though. Just know that if you choose to invest money that you may want to use in the near future, you risk that money dropping. So you put money into the market, and if the stock market crashes the same month that you need it, then you will be losing money, right? Going along with that, the market will go down. There are going to be fluctuations. That is completely normal. Do not panic. Don't look at your accounts if it's something that's stressful. Just keep on investing. If the market goes down, you do not want to pull your money out, especially if you're in your 30s, 40s, 50s, you are not yet retired. You don't want to be touching that money. Do not let it bother you. The market goes down, but it always goes back up. If you look at the history of the stock market, it has crashed many times, but it always goes back up, and it goes way further than where it was before. If you look at the price of a fund from 2005 and the price of it now, the difference is insane. And throughout that whole journey, throughout that whole 20 plus year difference, you see all these ups and downs. That is completely normal. So investing success is definitely not about picking the perfect fund or timing the market, anything like that. It is just being consistent, starting as early as you can, and to just continue investing no matter if the market is down, up, or any which way. And as I've already mentioned multiple times already, everyone's situation, everyone's goals are different. So there is no one size fits all to investing. But usually the order of investing, just investing alone, not taking into account like debt and everything else that somebody would be going through, would be as follows. So contributing up to the match in an employer-sponsored plan. Along with that, contributing what you can to an IRA, like a Roth IRA, or even maxing that out for the year. And then if you have money to invest outside of that, you could increase what you contribute to your employer-sponsored plan, or maybe you open a brokerage account and start investing there. However, if you are somebody who has any high interest debt, I would say anything above 8% really, but definitely anything above 12%. I would first focus on paying that down before investing heavily, because for the most part, you are not going to beat those rates in the market. So Focus on those debts first, and then you can come back to investing and switch things around. For this course, I did go into quite a bit of detail for each of these accounts and investing in general, so I'm not going to put the how to invest. I have separate videos on my YouTube channel of how to open a Roth IRA and invest your money with both Vanguard and with Fidelity. I also have a number of shorts that show you how to like auto invest your money or how to have your dividends reinvested. So if you don't know the how, like how to actually go and do these things, I have content on that. So I will have that link down below. If there's anything that you have questions on, leave it in the comments of either this video or on those specific videos or even the YouTube shorts, and I will do my best to answer. Or as I've been saying throughout this course, you can reach out to me or join my school community and get access to me directly. But let's move on to finally setting financial goals and then adjusting your budget, finalizing that budget that you made at the start of this. At this point in the course, it is a great time for you to set some financial goals. And I know this feels kind of backwards, like you should set goals at the beginning, but now you have a good idea of where everything stands, what your month to month will look like, and based off of these figures, you can set your goals. I suggest starting with setting just a few challenging but realistic goals. I want you to set too many or things that feel impossible, unless you want to, of course. And most financial goals are just math, so you can work backwards. So if you want to save up $3,000 and you have X amount of money left over on a monthly basis, then how many months would it take you to get to that emergency fund? Same with debt payoff. If you want to pay off $3,000 of debt within the next 6 months, then you need to be doing about $500 per month in order to make that happen. So you should be able to just work backwards. Here's a few outcome or number ideas. A debt-free date, pay off all credit card debt by a certain date or month, pay off a specific amount of debt by a certain date or month, finish your starter emergency fund by a specific date, investing a certain amount each month or throughout the year, reaching a certain amount saved in various sinking funds, or increasing your income by some percentage. There are also habit goals that you can set, and I do encourage you to do these because if you don't have these habits, then you probably won't hit those outcome goals. The first one being creating a budget, tracking your spending, and sticking to it. Reviewing your finances every Sunday or every month, whatever it may be. Or that could be with your spouse, having a weekly money date. Or even something like bring your lunch to work 4 times a week or only go out to eat 1 time a week. You get the idea. And don't just think of them. I want you to write them down, put them in a few different places. I also want you to reflect on them, review the progress that you've made on your goals. I suggest doing this monthly. I actually have a goal tracker that's available for purchase on my Etsy shop, and it makes it fun, gives you a visual, and you can see the progress on the goals that you're working toward. But hopefully by now you can see how things are coming together and you're starting to feel more excited about this whole process.
Quick note here that this is the point where you should be able to finalize your budget for the upcoming month. So be sure to update any expenses if they've adjusted and account for anything unique coming up. Hopefully you do have some money left over to work with and you know what you need to work on first. So whether that be your emergency fund, a sinking fund, debt payoff, or investing, then you can allocate that money accordingly in your budget. However, if you find your expenses are still greater than your income, don't panic. Continue watching because I'm going to go over multiple ways that you can increase your income or find money. And then finally, just another reminder that your budget does not need to be perfect and it will get easier each month that you do this.
Now I quickly want to cover ways that you can stop leaks in your spending, ways that you can increase your income, and even just achieving some quick wins. Starting with stopping leaks in your life, some of these things we've already covered, but they're worth mentioning again. And these leaks usually aren't anything huge. Those are more obvious, but even just $5 a day adds up. And that is often that's exactly why it's called leaks. Because think about it. If you have a tiny hole in a bucket of water, or maybe 2 or 3 holes in that bucket of water, it's slowly going to empty out. So sure, it might take some time, but eventually it will be empty. Same thing goes with your finances. I mean, just $5 a day of random spending is over $1,800 in a year. Here are some common spending leaks: unused subscriptions, excessive food delivery, frequent convenience purchases. So this could be like getting a snack at the gas station before you get to work or picking up a coffee before you get to work. Of course, interest charges on credit cards, Bank fees, overdraft fees, we've already talked about fees, but I want you to eliminate those. If you've been paying those months over months, I want those gone from this point forward. Never again do I want you to pay a fee. And then some bigger things would be buying things out of boredom and going shopping for entertainment or using it as a way to cope with emotions that you may be feeling. Of course, you don't need to eliminate everything. If it's something that adds value to your life or you don't want to give it up, then by all means keep it. But try your best to cut a few of those things and it will definitely help. And you will get to a point where there's nothing else that you can cut out. There's nothing else you can remove. There's nothing else you can reduce in your budget. That's completely normal. So at that point, you can work on increasing your income. Now, without getting too deep into this, and this also depends on where you live, but unfortunately, we do live in a time where having a second job, having a side hustle, making extra money, basically, if you have one source of income, it may not be enough. And really, it's kind of unfair. It's not ideal, but that is the situation that we are in. And we can try our best to control what we can control. And that is why I myself have always worked on having multiple streams of income and increasing my income, because at least that has created more opportunities in my life. So there are areas that you can find money, and then there's areas that you can increase your income. Starting with ways that you can find money, shopping around for car insurance, house insurance, renter's insurance, all types of insurance. As I mentioned before, I have a free tool that you can use to shop around for car insurance without entering your email or phone number. I highly recommend it. That's linked down below. Shop around for internet providers, shop around for cell phone providers, refinance your debt when appropriate, use gift cards that you may have forgotten about, redeem your points that you have with credit cards, or maybe there's like an app on your phone, or you use like Rakuten, a browser extension that you haven't checked in some time. See if there's money on there. One time I logged into PayPal after some time because it's an account that I don't check too often. There was money there. So I was able to get that money to my bank account and use it. So check everything that you have. And then also, if there is a fee that you've paid recently, whether that's an overdraft fee, a late payment fee, anything of that sort, when you're making your calls to your bank, or if you've already done that, do it again and see if there's any way that they can refund that. I have accidentally overdrafted my account. I've actually done that in the last year. I called them, let them know I didn't mean to do that. And you do need to fix the problem immediately. The time recently that I did overdraft my account, I immediately had money transferred over there. It was just because I forgot that I had paid a credit card and I didn't have enough money in there. It was like on a weekend or something. So it just took longer and I forgot about it. So if it's an overdraft, for an example, you want to make sure you fix the problem so that the account is no longer negative, then make the call, ask for a refund. If it's a late payment fee, you can explain your situation and be like, hey, this is really setting me back. I already am paying this, and I really can't afford this fee. Is there any way that I could have this refunded? I am working on improving all of this. There won't be any more late fees on my account. So you've really got to mean it though. You've got to mean it. You've got to be honest. Again, the person on the other line is a real human, so take advantage of that. So those are several things that you can do without dramatically changing your lifestyle and free up, maybe $50 in the month or even a few hundred in the month. And then for increasing your income or making more money, I would start with your current job. I know that the job market is crazy these days, so this is something that may take some time, but if you are at a job that's not paying you enough, or you have the opportunity to go elsewhere, start applying. Take it seriously, update your LinkedIn, do your research, put in the effort, and apply for higher paying jobs. Or at your current job, you could ask for a raise, pursue a promotion, work overtime or work extra shifts, earn certifications. Hopefully it's something your company could pay for. And then if you were to earn those certifications, also would increase your income, improve your skills to make yourself more valuable. And maybe there's a way that you could take on more responsibilities for a higher income, but all of that within reason. Of course, I know that oftentimes people are working jobs. They're already working overtime or working a whole bunch, doing more than they are being paid. And so if that's your situation, then I would focus on making money outside of your full-time job. So that could look like freelancing, consulting, coaching, tutoring, house sitting, babysitting, dog sitting, pet sitting, whatever, any sort of gig work, Instacart, DoorDash. Maybe it's even getting a second job, like a part-time job, working at a grocery store or serving at a restaurant in the evenings. Sell stuff that you no longer use, go through your clothes, look at your furniture, anything of that sort. Sometimes there's free stuff in, depends where you live, but people will put out something on the curb that people can take for free. And if you want to use that, if you're in a tough situation, you want to go pick that up, post it for sale on Facebook Marketplace or on Poshmark, something like that, by all means, please do that. Or maybe you could try flipping stuff, go to your local thrift store or a garage sale, buy something at a lower cost, fix it up if you need to, or just take nice pictures of it and then you post it for sale. Obviously, that does require a little bit of income to start with, but a lot of people do that as a full-time job, actually. So the possibilities with that are honestly endless. You can participate in research studies or focus groups, and then you could also try donating plasma. Please be careful with that one. That is only if you are, one, you need to qualify, but if you don't feel comfortable with it or you don't have the time or you don't want to do it, then yeah, be careful with that one. I think really all of this comes down to resourcefulness and resiliency and even discipline in there. Because if you were in a situation where you desperately needed $500 by like the end of next week, if you asked yourself, how am I going to come up with $500 in order to not be evicted or in order to save my life, to get dramatic, you will probably come up with an answer. You will find something, and usually it just requires, it could be a lot of effort, but oftentimes it's just a little bit of effort applied consistently, and you can make it happen. And then if you just do that month over month, stay dedicated to things and slowly improve your financial situation, it's going to get easier and easier. We're going to talk about that more in just a bit. But with all of this, please know that I do not want you to be miserable. I don't want you to put your life at risk, your health at risk. That is all way more important. You don't need to cut every single expense. If you want to do that temporarily, sure. If you want to cut out the Netflix, getting your nails done, getting your hair done, try that out for a month or 3 months, something like that. Go extreme, but then just know that it's temporary and that can come back. But I still want you to enjoy your life. I don't want anybody to be working like 100 hours a week just because they feel like, oh, I need to pay extra to my debt. Like, yes, that's great, but I want you to be healthy too and enjoy life while you're living it. So everything in reason, and try to find a little bit of a balance. But all of this to say, if you are able to reduce your expenses, increase your income, you've widened that gap. I've kind of always worked on widening that gap in my life. Lowering expenses, increasing your income. And eventually your expenses will start to go up, but early on, if you can take advantage of it, you now have less to pay for, more income. And so if you can direct that toward extra debt payments or extra savings or investments, then it's just gonna speed up your financial freedom even more. But now let's move on to organizing your money and building habits, because you can take action on all of this, but if you don't stick to it, then none of it matters. For organizing your accounts, I want you to know all of the accounts that you have and the purpose of each of them. And for the most part, at this point in this course, you should already have a general idea of all of your accounts. You've hopefully logged into all of them, saved that login information, bookmark it to your browser if you needed to. But for most people, you will have your primary checking account, which is how you do all of your spending. If you're not using credit cards, which if you have credit card debt, then you probably shouldn't be using it actively. So that's how you make all of your purchases and pay all of your bills. A high yield savings account or even a money market account. And this is probably where you hold your emergency fund and sinking funds. When it comes to an emergency fund, for you, I would be very clear on what counts as an emergency. And then for those sinking funds, I would really focus on the top priorities first, and then you can add more later. You probably also have retirement accounts like your employer-sponsored plan or a Roth IRA, and the money in there is what you will be using in retirement. So after the age of 59 and a half, that is the money that is going to support your future. You may also have investment accounts like a taxable brokerage account, and maybe that's an account that you are building up for a purchase in the next 20 years, or it could just even be to have for early retirement. If there's any accounts that you no longer use or they're just adding clutter to your financial situation, then feel free to close those, consolidate, whatever you need to do. Having a financial calendar is also really helpful, and this should have already been taken care of if you went through the financial snapshot section of this course. But this would include any important due dates or any important dates in general. So this could be paydays. Maybe there's some months where you will get paid 3 times in the month. So I would include that in your year at a glance. The due dates of your bills, the due dates of your debt minimum payments, any insurance renewals, any annual subscriptions, any tax deadlines, open enrollment periods are good to be aware of. Just any way that you can eliminate having to memorize things. It is so much better for you to have this somewhere organized that you can reference at any time. We've already talked about this as well, but a great habit is just automating things because that's less for you to think about and to do. I would still review things. So if you have autopay for your bills or your minimum debt payments or your savings transfers, your investment contributions, still check on things now and then, and you can still do manual transfers or whatever you need to if you want to. But I do suggest automating where you feel comfortable and once you get to that point. And now I want to walk through a really helpful system or routine that you can implement. And this would be annually, quarterly, monthly, weekly, and daily. This is roughly what I follow, and I feel really good about my finances. I'm very aware of what's going on, and this has only helped my financial situation. So you don't need to be perfect by any means, but slowly working toward this, I think, is just a game changer. Basically, the goal with having a system and routine is to become aware of any small problem so that it doesn't become a big problem later. So annually, or once every year, this one does have the most, I suggest creating an annual budget and updating your year at a glance. If you have no clue how to create an annual budget, I do have a video on this. Create and plan sinking funds if needed based off of that annual budget and year at a glance. Run your free credit report. We've already done this, right? If you went through the beginning of this course, you've already done it. So now you know you need to do this again next year. Review your goals and progress from the last year. This could be how much debt you paid down, how much you saved, how much you invested. Were you budgeting every single month because you work on tracking more? You get the idea. Set financial goals for the upcoming year. Calculate your net worth. I do recommend doing this at least annually. I prefer to do monthly, but I do recommend doing at least once a year. Review your subscriptions and any recurring expenses. See if there's anything you can clean up or eliminate. Review insurance coverage, health, auto, renters, homeowners insurance, life insurance if applicable. Review your beneficiaries or add them if you need to. You could increase your retirement contributions, definitely if your income has increased, but you may want to consider at least a 1% bump every single year to your employer-sponsored plan. Again, this is dependent on whether or not you have debt that you're working toward or something else that you need to figure out first. And then last thing would be to make sure you have 2FA set up on all of your financial accounts and turned on all of your alerts. So you are aware of anything that could be happening with your accounts, and then just make sure these days you got to be secure with accounts because hackers know how to get in. So be careful with that. Then there are things that you can do quarterly. So first thing would be to review the progress on your goals and your numbers so far. I like to do quarterly goals myself. So you could review your quarterly goals and set new quarterly goals, but not everybody does that. But at least look at the goals that you set for the year and how much progress you've made on them, or do you need to adjust anything? What could I do to get closer to that? You get the idea. Optional to calculate your net worth every quarter as well. So maybe one year feels like too far away, but each quarter is like your sweet spot. So you could do that. And then review your sinking funds and any upcoming expenses. Are there any sinking funds that you need to add in or increase how much you're adding to them? And then you should be good to go. Honestly, before we get to what you can do monthly, you could also do these same things every 6 months. So maybe not everything that you're doing annually, but like I was talking about before, I like to review my spending from the first half of the year and then kind of see what to expect for the next 6 months and adjust where needed, just so I'm more aware of how my money's going to be spent. Definitely reviewing goals. Maybe you want to check your net worth every 6 months instead of annually or quarterly. So yeah, these same things could be applied to 6 months. Monthly, I do really want all of you to be creating a budget before the new month. And sometimes people are like, oh, you have to create a new budget every month? Yes, you create a new budget every month because no month looks exactly the same compared to another. Making that monthly budget isn't something that should be too time consuming because you already have the basics. You have your fixed expenses and the things that often are occurring, but then you just gotta keep in mind the random things that could be happening in the month. Some travel, some gifts, you have to get your car registration. Yeah. You can log your final account balances on the last day of each month, or you could do the first day of each month if you wanted to. I like to do the last day of the month, and this is also when I calculate my net worth. So again, optional for you to calculate your net worth on a monthly basis as well. In just a moment, I'm going to show you my annual finance tracker that is available on my finance template. So if you're seeing that, feel overwhelmed by it, I'm going to show you what mine looks like and briefly how you can use it. It's actually very simple, and it's my favorite sheet to fill out. If you are no longer carrying credit card debt, then I recommend getting into the habit of paying off your credit card in full before a new month. I find that it makes budgeting easier. It makes the numbers easier, logging all the numbers that I have to much easier. So that is personally what I aim to do. It doesn't always work perfectly just because sometimes you may make a purchase on the last day of the month and it's still pending. It's not going to finalize until going into the new month, but then I just try to pay it off as quickly as possible. Honestly, it's something that I do. I make payments more often. Usually I make a purchase and then a few days later I go in and just pay it off. It just depends. So we'll talk about that in a bit. Also monthly, you can review your spending categories and identify any money leaks. We've already talked about that plenty, so you know what to look out for. And then if you don't have auto transfers, auto pay, any of that set up, then you can manually do those things on a monthly basis. So make your extra debt payments, transfer to your savings, your investments, etc. Now moving on to the things you can implement weekly, I do suggest logging into your accounts at least weekly. Not all of them, but the ones that you have things moving around, like active debts or definitely your checking account. Make sure things look okay, review transactions. If you're keeping an eye on it, then if you notice something, you can get it taken care of as soon as possible. As I talked about with monthly, I do aim to have all my credit cards paid off on a monthly basis, but you could also pay off your credit cards weekly. So maybe every Friday you are going to pay off all of your credit cards. And again, this is for people who are responsibly using credit cards and no longer have credit card debt. You're just using it to take advantage of rewards or points, or you're using it and you want to pay it off every month in full. So you could take that one step further and just have everything paid off on a weekly basis. And that does help prevent any sort of interest charges or late fees, gets you in a good routine and habit. I do recommend tracking your spending at least weekly. Monday through Sunday works for most people. That's what I have my clients do. So I make sure that they're tracking their spending at least on a weekly basis. I check their spreadsheets every Monday morning. If you go beyond that, it gets easier for you to forget things. You might miss things, or it just gets more confusing, feels more overwhelming, and then you are less likely to stick to this habit. So that is why I recommend at least weekly. And then you can review any upcoming expenses in the week as well. Make sure you have sufficient funds in your spending accounts so no new problems arise as far as that goes. Same with an in-between for these as well. Instead of weekly or instead of monthly, you may have a bi-weekly or like every payday. You could incorporate these things. So that's something to consider. It's very flexible. It's up to you. You get to choose what it is that you want to do. And then lastly, there's a couple of things that you can do daily. Personally, I like to track my spending in real time. So that means it roughly translates to me tracking daily. I usually am not spending money on a daily basis, but if I go to the grocery store, I get in the car, log my spending. Or at the very least, I come home and I log my spending. If I spend money on the internet, I then go to my spreadsheets and put it into the appropriate category. If I go fill up my tank at the gas station, then I sit in my car and, lock my doors, but I put it in my spreadsheet. That is something that I've done for years now. So it's just ingrained in me. It's a part of who I am. So don't be discouraged if you find it hard. You're forgetting often to log your expenses. But in my opinion, it's absolutely a habit worth establishing because I just think about money less that way. Actually, you'd be surprised. People think that it's very time consuming or that's all that I think about, but it's just a habit at this point. So I just kind of am in auto mode and go to do that, and then I don't have to worry about it later. I also recommend logging into your checking account on a daily basis. That is what I do. I like to check that because if that were to go negative, that has more consequences than if like a random transaction were to appear on a credit card. That is something that could be returned to you very easily. You could report fraud, whatever the case may be. But when it comes to your checking account, this is how you pay your bills. This is how you pay for everything. So even if you're using credit cards, that checking account is still the most important. So I have a couple of checking accounts actually. I do log into them just about daily, and it just gives me a lot of peace of mind. And I think it's a good habit to work up to as well if you want that peace of mind as well. And trust me, I know that that seems like a lot. You might be overwhelmed right now. Like there's no way I could be able to do that, but it just becomes a part of your life, and it is not overwhelming by any means. You probably will start to enjoy it as well. And I don't want your systems to be complicated or make you feel stressed out. I want you to do what works best for you. And if it feels like too much, then find a way to simplify it. Do what works best for you. And it's also completely okay for you to make mistakes. Like just expect mistakes. At the beginning, as you're working on all of these things, it's definitely possible that you're going to miss a few transactions. That is fine. Just try to get as much as you can. When you're making your budget, there might be a category that you completely miss. There are going to be months where you overspend. Every single month, there is something that's in the red in my budget. And that just happens. Like there's more that I spend in health and beauty, or, oh, the dog's got to go to the vet, so that's more expensive than I was expecting. But with that one, that is why I love annual budgeting so much, because when you zoom out, you're probably just fine. If you're sticking to your budget for the most part, if you zoom out and look at the whole year, the budget that you made for the whole year, then you are probably still right on track. There's probably also going to be months where you are not progressing at all. You could be even going backwards, especially at the beginning when you have like high interest debt, or you're still having a hard time not living paycheck to paycheck. That's completely normal. That happened at the beginning of my journey as well. I went into more debt a few months. It is very normal for your net worth to decrease, because if you have a lot of money invested, the stock market fluctuates, and so you may hit an all-time high and then the next month it drops significantly. That's not something that we can always control. And just in general, you might be seeing fluctuations in your progress, and that's completely normal. I just want you to try to maintain your habits, do what you can, and feel good about it.
As promised, I want to walk you through the annual tracker that you're seeing on my templates. I love this. I fill this out on the last day of the month. You could do the first day of the month if you wanted to, but it's a great way to stay on top of your expenses for the year, your balances, your debts, your assets, keeping track of your net worth, all the things. And of course, Google Sheets is always highly customizable. So if there's anything else that you want to add into here, you can absolutely do so. So this is mine for 2026 so far. I'm filming this mid-June, so I don't have June yet because that's what I would do on the last day of the month. But you can see that for May and every month before, I've been putting in my income at the top. So you will have that. You could add in a row here for your net income or something else if you wanted to, but I just have the gross total. So when I'm coming in to fill this in, you can type it in manually, or you can pull from other spreadsheets. So you can see that this formula is pulling in from my 2026 tab, and I just have it adding up my business income and my extra income. So I'm just pulling it straight in. And the way that you would do that is if you go, so for June, I can show it. So if I put the equal symbol, and from this tab, I'm gonna hop over, just go right over to 2026. We're gonna find June, my business income so far, plus we're gonna add in my extra income here. And I'm gonna hit enter, and that total will pull in. And if you cross-reference any tab, anything that changes over here will also update on this cell. So just keep that in mind. If you want it to stay in place and not move as any other number moves, then you may want to type it in manually. For the big red section, this is for all of your expenses from the month, and this is something I typically just do manually. The first time that you're entering in the data, like the first month that you're doing this or at the beginning of the year, it is the easiest because you could cross-reference a tab and just basically do equals and pull in the data straight away. But if the order of your expenses across your budgets changes at all, then it does make it a little bit more difficult. So that is why I pull this sheet up on my laptop, and then I open Google Sheets on my phone and I look at the month from there. Some of my expenses repeat, so it makes it a little bit easier. And so I'm like, okay, that one I know for sure is always going to be this, so I can just pull that over or type that in there. This is definitely the most tedious part of the sheet, but if your budget tends to stay the same on a monthly basis, as in you have the same expenses in order, or maybe you can plan for your budget to be that way, then you can do the same thing that I did for the income. So for example, if we're looking at my taxes, you can go equals, and then come back over to 2026 where you're looking at June, and I would pull in the actual amount. And we're not done with June, so this wouldn't look completely accurate yet. But if I were to drag this down, it would pull in the rest of the data that I have there. But you see, I no longer have my HSA in my June budget. It was there at the beginning of the year, but since it's not there anymore for June, this number is incorrect. So that is why I just do this part manually. If you're not using some budgeting app that will collect all of this data for you and add it up, then I do highly recommend filling this in, because this is what's going to help you to create an annual budget every year and also allow you to review your spending from the first 6 months of the year and then adjust going forward, because everything that you have listed here will add up YTD, year to date. It will tell you how much you have spent so far in the year per category, per line item. And then there's also a calculation. So this is calculating the percentage of spend compared to your income so far in the year. So as you fill in numbers, as the months pass, these will also adjust. These are things that I've put in myself, but this is how I easily make my annual budget. Basically, I'm able to see how much I've spent in the whole year, and then based off of that, I can make an annual budget for the following year. That is something I do on this sheet. So you can see this was what I had for 2026, and I just keep updating it. This was from before. Yeah, so I just kind of keep on adding to this sheet as it just depends. Also, by the way, all of your expenses will be totaling up at the bottom here too. There is a section for debt. It's not on mine because I don't currently have debt, but let me go back to, let's go back to 2021. Okay, so in 2021 I still had my car and I still had student loans. So in the purple section that says to debt, there should be a little note explaining what each section means. This is what you are paying toward your debt for the month. So in January of 2021 I put $2,498.24 toward my car payment, and then February I put this much. This is how much I put to my student loan. Well, at this time, this was during the pandemic, so I was saving for it, but I was counting these as debt payments. But you get the idea. If I was actually making these payments, that's what I put in here. And then those will all total up, and you can also see the total so far in the year as the months pass. And then the pink section is the balance of your debt on the last day of the month or first day of the month, whichever one you're doing. So this is all that was left on my car end of January 2021, and then by the following month I had paid it off. Unfortunately, I wasn't using this sheet before 2021. I wish I was, because that's when I had like credit cards and other debts, but yeah, hopefully you get the idea from that. And this will total up your debt. And you will want to make sure that you have enough space here and that everything is being accounted for, because it comes into play in the yellow section, which we'll talk about in just a bit. But let me hop back to 2026. Next, there is the blue section, and this is the same idea as the debt, but for savings and investment. So what you're putting to your savings, what you are investing. I like to put that on here just to see a monthly total. The way that I separate this is by putting my savings at the top and then leaving a space and putting my investments and retirement below that. I just put in what I add to these accounts. I don't actually include anything that I take away from it. You can if you want to. So if you were to completely deplete, like recently I depleted my travel sinking fund, so I could make this a negative number, like how much I put in, and subtract how much I took out, and it will obviously update the total appropriately. I find it easier to just type in what I've saved, and then I like to keep track of the balance below that. Also for this one, it will add up year to date on the right hand side. So then the teal section is how much you actually have in your savings and retirement or investment accounts. So I have the savings up here, everything that you saw up here, I just keep the same order. And then this is just the balance, again, a number that I log on the last day of the month. It will total up here. My retirement accounts on the last day of the month here. I do put a note just to show the growth from one month to the next, but that's personal preference. And then that will total up here. And then all of it will, I'm going to make it bold because I think I had changed that at some point, but then all of it totaled up here. Those are my assets. If you have debts, that would be totaled up from the pink section. And then everything that you've entered in the pink section, your debts, everything you've entered in the teal section, your assets, will pull down to the yellow section. I took out the cells for liabilities. You honestly may need to add some space if there's not enough room, but you shouldn't have to touch really anything in the yellow section except for adding in your checking balance if you didn't account for that up here anywhere. So that's all that I do. Everything I mentioned above is pulled into here, and then I also put in my checking balance manually. So I just type that in. But all of these you'll see a formula for. So F76 is just referencing F76 here. So that's just pulling down. If anything with this were to change, if I were to make this a 1, that becomes a 1 as well. So if you are seeing any mistakes or something is thrown off or it's not pulling in correctly, you should be able to see the formula and adjust. But if you need any help with this, reach out in my community. I can absolutely clean up your spreadsheet for you, because I know it's not super easy for everybody to adjust the formulas, but hopefully it's nothing too crazy. And if you have your assets, you have your liabilities in there, it will calculate your net worth for you automatically because it's just subtracting the two. And then there is a section here for your credit score. I just like to track my score from Credit Karma, so that's actually my Vantage score, and that's what I pull in. There's also a chart. There'll be a chart on there for your net worth, and it will update once you actually put in numbers. If you have the zeros for the months that are not logged, which you will if you're using my template, then it will look a little bit wonky, but eventually it will be actually representative of the changes in your net worth throughout the year once the year is actually complete.
All right, y'all. I am very excited to say that we have reached the final section of this course, and that's going to be on financial independence, which is very fun. Everything that I've discussed in this course and the things that you are doing, taking action on, changing, improving, adjusting, working toward, will help you get to financial independence, financial freedom, whatever you want to call it. There are many different styles of financial independence, but I don't see why this wouldn't be everybody's goal, because financial independence creates options in your life and allows for a lot of freedom, financial freedom. It's right in the name. So you may have heard of the FIRE movement, which it's just an acronym, Financial Independence, Retire Early. I'm not going to dive too heavy into that, but really the main focus for a lot of people is just financial independence. The retire early part of it is for some people. Maybe you do want to stop working at some point in your life, like completely stop, but most people don't want to stop working. They just want to do something that's more meaningful. Maybe you want to pursue passion projects or start a small business. And so in order for you to make that happen, you want to take off a year from work. And those are all things that are possible by doing all the things in this course and working toward financial independence. Outside of that, financial independence is really about having choices, reducing hours if you want to, going down to part-time, traveling more, starting a business, spending more time with family. You see that it is things that you have options now, instead of like, oh, I have to go to this 9-to-5 job, or I have to work 80 hours a week because otherwise I can't keep up with everything I need to pay for. But with everything that I've covered in this course, the reducing your expenses, increasing your income, having more money invested, getting out of debt, after some time, you should have a pretty solid financial foundation. And that would mean like less debt or no debt, a high amount in savings, a high amount in investments or retirement. So if you had a horrible boss, you could quit your job. Or if you did want to take the leap and take your business full time, you could do that and feel more comfortable. That is the goal with all of this. And you might just be at the beginning of your financial journey, and everybody starts somewhere. So right now you might be looking down the tunnel and there is no light, but I promise you it will eventually be there. And then it gets brighter and brighter, and you will achieve all your goals if you stay consistent with this and just keep at it. It is 100% worth it. I wish I could spread this message to more people, because it's just like going to the gym. When you go to the gym and have a lifting session, the next day you're going to be sore. And so that discourages people from going back, because they're like, I am too sore to even move. So the next day they don't go back. The next day they're still sore, so they don't go back. And then it's just out the window. They're not going back. They try again in a month, the same thing happens. But really what those people don't know is if you just go to the gym again, you probably will actually feel better. You're sure you might be a little bit sore, but once you start moving your body, it's going to go away. And then if you just go every day, a few times a week, you're you're not going to be sore and you're going to make a habit out of it. That's the same thing with finances. Right now, it feels hard. It's going to be slower. Your progress is going to be slower, but eventually it gets easier and your progress is going to speed up. And I want to show you some numbers behind this because I think oftentimes people hear like $1 million or $2 million. That's how much you want in retirement. And you're like, oh, I have $8 to my name. How am I ever going to get there? Again, this is going to take time, right? But when you look at, this is an investment calculator through calculator.net. It's free to use. You can throw in numbers and mess with it. These are just rough calculations. It's very simple numbers thrown in there, but you can see what is possible with this. And so let's say right now, let's say you have $0 invested, okay? Let's say right now you are 35 years old or 40 years old and it's going to take you 5 years to pay off your debt. And maybe you have some invested, but we're going to make it simple and say that you have nothing invested by the time that you hit 40 or 45, whatever it is. So you have $0. And then if you're 40 or 45, you have a good 20 years ahead of you until traditional retirement age. Maybe, we're living longer, so we'll probably work a lot longer. And maybe at some point you could go down to part-time work depending on your saving situation. You get the idea. It just depends. Everything is possible. We will keep this conservative return rate of 6%. And then we're going to keep the compounding it annually. Let's say that you start contributing $1,000 a month. So that means by the time you turn 60 or 65, you would have $453,000, give or take. But if you could increase how much you're contributing, because keep in mind, if you don't have debt payments anymore, you are maybe in the peak of your career, so you're making more money than ever, or you got a side business going, making extra money on the side, maybe you could do $1,500 a month. And so then you would have $680,000. And this is technically somebody who started late, and this is at a conservative return rate. So what if we bumped this up to 8%, like you're invested all in some good stocks? $853,000. What if you start contributing $3,000 in a month? After 20 years, $1.7 million. And so you can plug in your numbers here, what you're starting with, how long until traditional retirement age or any retirement age, how much you are adding on a monthly basis or even annually, and just take a look at your numbers. There are also other calculators out there. If you heavily want to get into the FIRE community, there are blogs, podcasts out there that you can listen to. There are also calculators for CoastFi or BaristaFi that are out there. This one is just a very simple investment calculator. If you're looking for a number to aim for, how much to have in retirement and investments, a good rule is the 25X rule. For example, if you wanted to spend about $40,000 per year in retirement, then you would need about $1 million invested. Now, keep in mind that inflation has it's been going up. We know that. And $1 million of today's dollars will not be the same thing 20, 30, 40 years from now. I completely understand that, but that is all noise. Do not listen to when people are saying that. I would rather you have something than nothing. And so if you just have $1 million by the time you hit 65, that is significantly better than so many people these days. So do not let it discourage you. If you want to feel more confident and comfortable in your financial situation in retirement, then you want to work on saving more and investing more. The goal is freedom and options, y'all. So this isn't really about getting rich or anything. Great. If you get rich, amazing. And if you want to spend your money on cars, on clothes, because you have the means to do so, then great. But that's not what financial independence is about. Oftentimes you will see people in like older cars and just regular clothes, nothing designer, modest homes, because it is more important for them to have that freedom in their life than physical belongings or like some sort of status in society. And if you feel behind whatsoever, that's normal. That's fine. But the important thing is that you are starting now. So if I know I keep saying it, but if you implement all these things and just keep at it, you will get there. You'll at least be in an improved situation, and you might be surprised how far you can get yourself. And one final thing with all of this is that you're probably going to evolve with time as well. If you want to start a family, if you want to buy a home, if you want to go back to school, your goals will probably change. Nothing needs to be fixed in your life. I just think it's important to maintain these habits and these things that you've implemented so that you can adjust and figure things out. It just makes the process so much easier. All of this comes down to creating a financial situation so that you can live a life that you actually want to live and feel proud of, happy in, and will look back and be like, hey, I did pretty good for myself and I'm content with things. I know this was so long, and I know that there's so many things that I didn't touch on, and I apologize for that. There's only so much that I guess I could keep on going and make this like a 10-hour course, but hopefully this covered the main things for you and you got a lot out of this, and hopefully it was helpful. If it was helpful, I would really, really appreciate if you gave this video a thumbs up. Be sure to subscribe, comment down below. All of that really supports me. Also, if there's anybody in your life who you think this video may benefit, then please share with them. But truly, thank you so much for being here. And if you need any additional support, then check out my community or my coaching packages. I would absolutely love to be a part of your journey.